The Fed just has a lot less influence on the direction of things than they've had in the past.
We want the Fed to react before we see a big problem.
It does feel as if the balance of risk is pretty balanced at this point.
It's clearly long-term rates that drive the bus here.
Even if they cut in September, it's then not going to necessarily be a slam dunk that there'll be a December cut.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday. Thank you, Jay.
Downside risks to employment are rising. The effects of tariffs on consumer prices are now clearly visible. A reasonable base case is that the effects will be relatively short-lived. The shifting balance of risks may warrant adjusting our policy stance.
Fed Chair Jay Powell helping to unleash a major equity market rally. This week, investors turning their attention to earnings from tech giant Nvidia just after the White House makes a move to take a 10% stake in Intel. That stock trading high this morning.
Semiconductors are clearly in focus this week because, Jonathan, once again, whether or not it's Nvidia, whether or not it's Intel, we've seen a more interventionist approach from this White House. The president, within 15 days, went from urging the Intel CEO to resign, then saying he came into the Oval Office and he said, you know what, actually, I want a stake in this company. The signal Wall Street needs to take from this White House, though, is that this approach is not slowing down. The president said himself, I'll do more of them.
And there's more to come. Government intervention can have unintended consequences, and we should talk about that. With regards to Intel, 30% of revenue coming from China. I'm still waiting for the Chinese response to the fact that the government now has a stake or will have a stake in this company.
Well, China basically might say, good, you're doing what we've been doing for years. You're taking an approach that Beijing has been doing when they have invested and taken an interventionist approach from their national champions. This is what is also going to be so interesting, Jonathan, when Nvidia reports this week. What is happening with their Chinese business? Remember when Beijing said, actually, please start snubbing those chips and start going for our national champions? And the information is reporting that Nvidia is telling their component producers to hold off and stop making them. Are the H20s even viable anymore in Japan, in China?
Intel in the pre-market higher by 2.9%. Bond yields just a little bit higher after a big move last week. Let's talk about fixed income. Higher by a single basis point. The 2-year 370. 10s at 427. A major bias shift from Fed Chair Jay Powell over in Jackson Hole, Wyoming, after pledging to anchor inflation expectations, pledging almost to put a floor under the labor market.
It was almost like Governor Waller wrote that speech that Chair Jay Powell delivered on Friday, Jonathan. He opens the door. The question, of course, becomes, does he walk through it in September when the Fed meets? I think you still have to take into account that on the sidelines, Susan Collins, Austin Goolsbee, others were still talking about the fact that they are concerned about inflation. September 5th, we get another read on the labor market, and September 11th, next CPI report. Both of those reports leading into the Fed meeting.
A week later, September 17th, for the Federal Reserve to get together. If you are just joining us, welcome to the program. Very close to all-time highs at the close going into the weekend this morning, negative by 0.2%. Coming up this hour, we'll catch up with Bob Elliott of Unlimited Funds with stocks on the brink of record highs, Frank Lee of HSBC looking ahead to earnings from Nvidia, and Steve Ricchiuto of Mizuho on why a September rate cut may not be justified. We begin this hour with stocks steady after Chair Powell helped unleash a powerful equity market rally. Bob Elliott of Unlimited writing, Fed Chair Jay Powell clearly prioritised the labour market over the inflation mandate. But if growth is weak enough to inspire aggressive cuts, it's far too weak for stocks at current levels. Bob joins us now for more. Bob, good morning.
Good morning.
Let's just start with that speech. Have we abandoned that 2% target?
Well, I think the rhetoric says that the 2% target's going to stick around, but let's be honest, they've missed it for 52 months. They're likely to miss it for another year, given what Powell said yesterday and the pressures coming from tariffs. And so, I mean, if you fail at your job for 60 months, it's not particularly credible that they're prioritizing the inflation mandate. It's clear what's happened is we've had another reaction function shift. I mean, your head can spin at the number of reaction function shifts we've seen over the last couple of years. And this one is back towards concerns about the weakening labor market. I think the issue and why we might be seeing a little buyer's regret this morning is that if conditions are weak enough for the Fed to start to cut aggressively, they're far too weak for what we're seeing in the stock market.
This word curious, let's use this word curious that the Fed chair used on Friday to describe the situation in the labour market, to describe his words on inflation. A one-time shift in the price level, of course, one time does not mean all at once. That line there from the Fed chair, I think, sets us up to ignore hot prints on inflation for months to come, and maybe longer than that. How sensitive are we going to be to incoming information over the next 6 months?
Well, I think we're, at a broad level, creating one of the greatest macroeconomic experiments we've ever had, in 150 years, which is hiking tariffs to their highest level in 100 years in the largest economy in the world. And so there's a lot of uncertainty about how that's going to flow through. And we're just starting to see the effects. And so any reasonable analyst will say there's not a lot of confidence about exactly when we're going to see the inflation peak or how much is going to hit earnings onshore. And so it's reasonable to say we're not going to really understand exactly how it's going to flow through. What's not reasonable is to basically say, forget inflation. It's transitory, dare I say the word, implied by what was said there.
He basically said it without saying it. Correct.
I mean, it's about as transitory an argument as he could have made there. And that means basically no matter what happens on the inflation side of the mandate, it's just going to get ignored. This is all about the labor market in the next year.
When he's reacting to the labor market, does it look political now, given the fact that, as you and Jonathan were talking about, this is widely different than what he was talking about just 4 weeks ago?
It is certainly curious that he said that the labor market was strong and argued at length in the presser about the tightness of the labor market, 4 weeks ago? And then here we come and look at the speech last week, and it looks dovish, concerned even about what's going on in the labor market. Under the hood, it looks as though this is a little bit of a Frankenstein speech where his views are certainly included there in terms of talking about the tightness, but then giving a nod to those folks who are more concerned about the labor market and, frankly, more dovish tilting here.
So this was a collective speech, you think, from input from other members? It
certainly looks divergent from what was said a few weeks ago in the presser. It also looks pretty divergent from what was printed in the minutes. And that's interesting because the minutes were written after that labor market data was out, and minutes are often revised when there's incremental important information that comes out. And so that suggests that the dovish side of the FOMC may have taken control in terms of authoring this. Now, look, to be charitable, maybe what's happening here is Chairman Powell is trying to take a little heat off of the FOMC, particularly given some of the challenges to independence we've seen in the last couple of weeks. I think the problem with that is, as we saw through the course of the weekend, just a little bit of dovish tilt is not going to take the heat off this FOMC.
Should we talk about market consequences? Equities off to the races, rocketing higher on Friday. Bond yields lower across the curve, 2s out to 30s. There are some people writing this morning that maybe you might see an inflection at the long end of the curve, that this kind of reaction function, this setup into the rest of this year, could actually generate high yields in the same way they did 12 months ago. What's your view on that?
I think it really comes down to whether the monetary policy is responding to the growth conditions. And so if we're actually seeing a weakening of economic conditions, actually bonds here look like a good buy. I mean, look, yields, whether you're looking at long end real yields or nominals, they're at cycle highs at a time when we've seen a clear slowing of the economy. And so, if you look at, for instance, how hedge funds are positioned right now, what you see is actually bonds are a buy, a pretty non-consensus view out there relative to what most people on the street are saying.
How does that stack up with your call on equities?
Well, I think it basically favors, bonds are basically at lows and equities are at highs at a time when growth is slowing. And typically when you see that setup, that's favorable to bonds relative to stocks. And the one area that could come out of this, which is if the Fed does get very aggressively, let's say proactively easy, you're going to see that in the dollar. We saw a lot of, pretty weak dollar response on Friday. And, in a big picture level, the dollar's down somewhat this year, but DXY has traded down into the 80s, into the 70s. And so we're a long way away from a weak dollar environment.
Bob, what happens if they don't cut in September?
Well, I think there's certainly going to be a lot of political pressure that's going to come.
But for equities?
Equities are, it really comes down to the data. I think that's the basic issue is if we see a strong labor market print, then I think equities are going to hold up here and things are going to be fine. But the real challenge, the real risk for the equity market is we see continued soft labor markets, elevated inflation, which will almost certainly come in the next CPI report, and a Fed that is a little hesitant. Now, I think it's going to be quite a pullback. It's going to be hard to see all that data and not cut, given what was indicated on Friday. But that's the risk. The bigger risk for equities is basically that you have weakening growth and you don't get that easing that's necessary.
We've all used that word curious now a few times already this morning. When he described the curious labour market, it's curious that he's putting more emphasis on the demand side of the story and perhaps less on the supply side of the story. Are you doing the same thing?
Well, I think when you think about what's going to drive stocks don't care about the tightness of the labor market. They care about growth. And to the extent that growth is slowing because there's a supply constraint in labor and that's reducing incomes in aggregate in the economy, that's weak for growth and should be weak for stocks. And we've already seen, GDP final sales, nominal final sales was, 2 or 3% in the last quarter. That's very weak relative to the potential, the typical potential of the economy. And so, if you're focused on monetary policy, typically the tightness matters. But if you're focused on stocks and bonds, it's going to come down to what's happening with growth. And so that curiosity isn't really all that relevant to what's going to transpire for stock and bond pricing.
Well, it's good to see you, as always. Thanks for dropping by, sir. Thank you very much. Bob Elliott there of Unlimited Funds. Finally balanced on the Federal Reserve going through the rest of this year. But September, it looks like the Fed chair opened the door wide open for rate cuts.
And what happens if he doesn't, given the fact that he did open that door? Pretty much everyone's expecting him to walk through it. I love what Bob had to say, though. Potentially this is a collective speech, input from other members. And maybe, Jonathan, that is the Fed chair trying to keep the heat off the FOMC right now, but not sure that's going to work with President Donald Trump.
That's the latest on the Federal Reserve. Let's get you the latest stories worldwide with your Bloomberg brief. ECB President Christine Lagarde warning against political interference in central banking. Lagarde saying if monetary policy independence is undermined, quote, it becomes dysfunctional and starts doing things that it shouldn't do. Elsewhere, the Canadian Prime Minister Mark Carney visited Kyiv on Ukraine's Independence Day, pledging support. Speaking alongside President Zelensky, Carney said peace with Russia must come through strength and did not rule out providing Canadian peacekeepers. And finally, Keurig Dr Pepper agreeing to buy Dutch coffee and tea company JDE for $18 billion. Once the deal is completed, Keurig plans to split the coffee business from other beverage operations. Their stock is negative by 3.4%. Up next on the programme, piling the pressure on the Fed.
President Trump, you're going to fire Lisa Cook, the Fed governor, over her mortgage fraud?
If she doesn't resign, what she did was bad. So I'll fire her if she doesn't resign.
That conversation up next with George Pollack of Signum, live from New York City this morning. Good morning. Snapped a 5-day slide in Friday's session. Equities, the biggest one-day gain since May. Pulling back this Monday morning by about 0.25% on the S&P. No drama here. On the Nasdaq 100, down by about 1/3. If you check out the bond market, 2-year, 10-year and 30-year bond yields this morning, higher across the curve after a big rally in Friday's session. We unwind some of that. Check out the very long end of the curve. Yields higher on a 30-year this morning by about 3 or 4 basis points. The 30-year, 4.91. That's the one to watch through the next few weeks. The front end's going to be super anchored by whatever the Fed chair sets us up for relative to the data over the next few weeks. Of course, Annmarie went through the data. Payrolls the first week of September, CPI the week after that. Do we see a repeat of last year where they cut rates at the front end and rates at the long end continue to climb by about 100 basis points? That's the bond market set up this morning. Under surveillance this morning, piling the pressure on the Federal Reserve.
President Trump, you're going to fire Lisa Cook, the Fed governor, over her mortgage fraud?
If she doesn't resign, what she did was bad. So I'll fire her if she doesn't resign.
It's the latest this morning. President Donald Trump threatening to fire Federal Reserve Governor Lisa Cook if she doesn't resign over mortgage fraud allegations. Governor Cook has not been formally charged with any crimes. Joining us now from Washington, D.C. is Bloomberg's Tyler Kendall. Tyler, good morning.
John, good morning. Well, this really marks the latest escalation by the White House. And I think it's fair to say that it was a little surprising that we didn't hear from President Trump comment directly on the message from Fed Chair Jerome Powell on Friday, but instead escalated this threat to fire Fed Governor Lisa Cook if she does not resign over allegations of mortgage occupancy fraud. And we did have the FHFA Director Bill Pulte on Bloomberg Television last week, who told us that this is part of a broader crackdown when it comes to the issue of mortgage fraud. But it's, of course, raising big questions here in Washington, one, over the motivation, but also over any potential legal ramifications, because there is a very high legal bar to remove a Fed official. And we actually saw that protection bolstered by the Supreme Court earlier this year. Now, you mentioned it, but it bears repeating. There have been no formal charges brought against Cook, and she herself responded last week saying that she will not be bullied into leaving her position and that she is gathering the accurate information to answer any sort of legitimate questions. But I don't need to tell you, John, that a potential opening would pave the way for 4 out of 7 of the Fed board seats to be filled by Trump appointees. But that doesn't necessarily mean that President Trump would even get his way when it comes to monetary policy. And we really did hear that sentiment echoed by current and former Fed officials alike. John, I caught up with former Kansas City Fed President Esther George last week, who said that as more pressure comes to bear, that does cloud the public's view, but that ultimately that's not going to cloud the view of the decision makers at the table.
Tyler, what's been the reaction in Washington to the president once again going after a member of the Fed?
Well, it depends who you ask, Annmarie. Of course, Republicans have really stood by President Trump's efforts here, saying that he has his fair right to voice his opinion when it comes to the future of monetary policy, and that he's trying to do what's best in his view when it comes to the economy. But we do know that many of those Senate Republicans on the banking committee, for example, have voiced concerns that ultimately, at the end of the day, they do want to see a central bank that is independent and able to make its own decisions. So Republicans, for the most part in Washington, have really been walking that tightrope so that they can be in favor of the president's view, but that they're still making sure that the Fed is data dependent.
Tyler Kendall with the latest. Tyler, thank you. More from Tyler in the next hour. George Pollack of Signum writing the following: Cook is likely not inclined to resign as her term goes until 2038 and would rather have the legal fight determine what for cause actually is. George joins us now for more. George, why is this different to what we saw play out with the former Dallas Fed president Robert Kaplan when he decided this became a distraction over his financial disclosures and he resigned, as did Eric Rosengren for different reasons later on? George, I just wonder why we see this as slightly different.
So at Signum, we see this as slightly different because Governor Cook would understand that if she were to resign and take the hit of resignation, that would give the president an opening to a majority on the Fed Board of Governors. And for the Governor Cook, she views this as completely false and not an accurate allegation, and from Bill Pulte basically misunderstanding what occurred, and she wants to push back. And with her term going through the 2030s, she doesn't want to give up that term, potentially impact her party, potentially impact the Fed's independence, and give the president, while not a clear ability to impact the FOMC, at least take a step forward towards massively changing the Fed, its independence, and how the FOMC votes.
George, at Signum, do you view this as an issue of Fed independence, or is there actual accountability that needs to be brought to the Fed? Has there been poor oversight at the Fed?
I think that's a really fair question. We've seen the nominee for Kugler's remaining term, Stephen Moran, lay out that point. I think one big issue that a lot of people will have with his action against Cook is it's the Trump administration making this argument. And while if the allegations are proven, we understand why the president would feel inclined to fire her, it's difficult for a lot of people from the policy and politics side to understand the Trump administration claiming some sense of propriety or concern about the morals and ethics of government officials while continuing to take certain actions that have raised questions.
George, where is this fight going next? What happens next? Does this end up just in courts?
Well, that's the issue. So we've never actually had a Fed governor fired for cause. So while we have the standard laid out that includes malfeasance or inability or incompetence, the test, it's never been tested. And that's kind of why we think the president will go forward with the firing of Lisa Cook, because either way, either the court backs her or it backs the president, but at the very least, he will be given a roadmap on which to operate and which to understand where the for cause protections apply.
George, I just want to push the legal proceedings to one side because they haven't officially started just yet. And as we've said repeatedly on this programme, and I think you and I have talked about it too, it's difficult to engage with a legal process that hasn't even started just yet. But what's curious to me is some of the language that people are using when they talk about this story. They talk about things about they don't want the president to make a decision to replace Governor Lisa Cook with someone that he wants, and that somehow Lisa Cook herself would be concerned about that. George, as we engage in that conversation, aren't we just accepting that some of these individuals are politically biased themselves?
I think what we're accepting is kind of like a parallel to the Supreme Court, where they preserve their independence, where they maintain their independence, but at the same time, many people in American politics and policy have interpreted it widely as they wear the jerseys of their team, be it Republican or Democratic. And I think as we've seen politics and policies impact theoretically independent institutions like the Supreme Court, and now under President Trump, like the Fed, I think we're just seeing more of a public willingness to discuss the fact that there are politics that are considered in the Fed, and that the Fed doesn't ignore politics. And I know Dr. Sarah Binder at Brookings has laid this out, that the Fed isn't so much an independent institution, but it's more so an interdependent institution, and it depends on protection from institutions like Congress. So we've kind of seen that a transition towards that becoming the more dominant theory.
When it comes to what's next in terms of the Senate getting back in session in September, do you think we're going to see Steve Myron get a vote before the next Fed meeting?
We do. At Signum, we actually think he's going to get a vote before the next Fed meeting, even though that does require the Senate to act quickly, which it's not typically inclined to do. The parallel I have is from the Supreme Court nomination after Ruth Bader Ginsburg died, where they were able to confirm Barrett in 30 calendar days. And that was for the Supreme Court. Myron has already been confirmed for a Senate confirmable position. He's already served in an economic capacity, and it's for a short-term appointment. It's only for 4 months. Neither the president nor the Senate Republicans will want to have him miss any FOMC meeting that he can sit on. And it's our belief that the president is going to make this into a litmus test. And with Chairman Tim Scott generally inclined to go along with the president, we think that making it a litmus test will lead to success and will lead him to sit on the FOMC come the middle of September.
George, do you have any thinking now? Has it changed at all about who do you think Trump's going to pick to be the next Fed chair?
So in our conversations, we've always come around to, the two Kevins. We've seen the conversations about David Malpass. We've seen the reports about a more expanded list of targets from people who are not so much Fed experienced. But we still think in the end, while those names are out there and they're out there for positive reasons, and they could bring the independent and disruptive thinking the president seems to want to bring to the Fed, we still think it's more along the lines of people like the two Kevins, more so than out of the box names that we've seen discussed in the past couple of weeks.
George, appreciate your time. Thank you, sir. Enjoyed the analysis. George Pollack there of Signum on the Federal Reserve. If this was about sports and if this was about performance alone, like who's in the best form right now? The individual in the best form on the FOMC right now is Governor Waller.
Absolutely.
And you nailed it at the top of the programme. The very fact that the chairman's come out a number of months after Governor Waller has and basically echoed everything that Governor Waller's been saying that predated non-farm payrolls after that news conference with Chairman Powell. That tells you the guy who's best positioned to run this central bank at the moment is an individual already on it. It's Governor Waller.
Absolutely. And you could take Bob Elliott's point of view, saying maybe Powell was leaning on to some of the input from the doves in the committee, those two dissenters, including Governor Waller, at the last Fed meeting. But really, it was almost like Governor Waller wrote that speech. All of these talking points that he has been making for months, Powell has finally come out and said it, which is why many people think he's really the guy that at the end of the day, the president is going to tap. But what's interesting there, George said, he goes back to basically the originals, the OGs we've been talking about for months.
The Kevins.
No one really is talking about this 11-person list that the Treasury Secretary's put out. Even the president himself, Trump, said, there's really just 2 or 3 people, and I'm going to decide on those.
Equities in a moment. If you're just joining us, welcome to the programme. We are negative. We are just off all-time highs. We're down about 0.25% on the S&P 500. Big week coming up for earnings. In just a moment, we'll catch up with Frank Lee of HSBC, raising its price target on Nvidia going into earnings this week. Plus, we'll catch up with Danny Berger. We'll get you some morning movers with Keurig Dr. Pepper sliding in the pre-market. That stock is down 3.4%. Live from New York City this morning. Good morning. Equities negative by 0.3% on the S&P 500, pulling back from the best day since May on Friday, and the gains we added to the S&P 500 very, very close to all-time highs on the S&P going into the weekend. Coming out the other side, just a little bit of weakness. Check out the bond market. Just want to focus on the difference between 2s and 30s. The distance between the two, the longest, the widest, going back to 2022 in Friday's session. But that gap is opening up again. We're up by 4 basis points this morning on 30s, 491.21. Just want to know that on the open on Friday, we opened up at 491.93. So that predates Chairman Powell, that 491.93, and we're basically back to those levels. And it's this discussion about what happens at the long end that I think we're all gripped on in fixed income at the moment. Do we see a repeat of what we saw last year? And this could be a massive problem for the Federal Reserve. And a massive problem for the White House too. This White House wants lower rates, but what they ultimately want is lower borrowing costs and lower mortgage rates. And at the moment, there's going to be a big question about whether they get that or not.
This is the biggest conundrum facing them right now. They want the Fed to cut. And part of the reasoning is they say American families, businesses, they want lower rates. They want to get on the mortgages. They want to get on the housing ladder. But what did we see a year ago? The Fed cut rates and mortgages actually went up. And this is an issue, is what if this happens yet again? This doesn't solve the problem that they're looking for.
Just seeing bond yields bleed a little bit higher at the longer end of the curve. Want to finish on foreign exchange, check out euro dollar, and just check out the difference between the two central banks right now, the ECB side versus the Federal Reserve. On Friday, Chairman Powell leaving the door wide open to reduce interest rates on September 17th. The Bundesbank president sitting down with Lisa and TK, basically saying the bar for another rate cut from this ECB still super high. Some euro strength on Friday, just a touch of weakness this morning, down by about 1/3%, still around 117, 116.86. As we count you down to the opening bow, that's the price action. Let's get you some single names, some morning movers. Let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. Merger Monday in full swing. Keurig Dr. Pepper will be buying the Amsterdam-listed JDE Peet's. Usually the choir falls when this happens, so not unusual to see shares down about 3.4%. After it's done, Keurig Dr. Pepper will split its coffee and its beverage business into two separate listed entities 7 years after they merge. All of this really just underscoring the difficult environment for beverage companies with changing consumer preferences and some differences in commodity prices. Next, some Washington action affecting single names this morning. After the bell yesterday, we learned that the U.S. government would indeed be buying a 9.9% stake in Intel for $8.9 billion. That funding would be coming from the CHIPS Act. Those shares up 2.4%. The government won't have any voting rights or any other governance rights, but Bernstein analysts underscoring that, sure, Intel needs money, but more than that, it needs customers. Now, the last thing moving on Washington, D.C. action, Wayfair this morning, one of the poorest performers in the pre-market of a certain size, down 5%. Trump, again, after the bell yesterday, announcing that the U.S. would be launching an investigation into furniture being imported into the U.S. He said after that investigation, about 50 days, they would look at sectoral tariffs. So again, Wayfair shares and some of the other furniture makers falling in the pre-market trade, John.
Danny, thank you. Appreciate the update. More from Danny in the next hour. On our radar this morning, one of our top stories worldwide, Fed Chair Jay Powell leaving the door wide open for a rate cut at the central bank's September meeting. Powell highlighting risk to employment and impacts of tariffs on inflation that could warrant adjusting policy. Elsewhere, Vice President J.D. Vance expressing confidence the U.S. can broker a peace deal between Russia and Ukraine. Vance saying we've seen significant concessions from both sides in the last 2 weeks.
I think everyone knows what the concessions are on Ukraine's side. The interesting part was really what J.D. Vance, the vice president, was talking about concessions on the Russian side. He said they conceded in the recognition that Ukraine will have to have territorial integrity after the war, that they're not going to be able to install a puppet regime in Kyiv. And then, of course, what they view as a major concession from Moscow was the fact that there will be this security guarantee. You had Mark Rutte go to Kyiv on Friday. They are trying to work out what a security guarantee could look like, this assurances for Ukraine. The issue is, Jonathan, how many times have we been here with this country? Minsk, there was a memorandum in the 90s because of this, and yet again, we still had an invasion. And this is what is going to make it so complicated. But this administration still tries to narrow that gap.
In the 90s, it was Budapest, right?
Yes.
Let's just build on that a little bit, because I imagine that's going to make Ukraine very nervous. And I'm not sure how many people are aware of what was actually agreed in the 90s and how eerily similar some of the language being used now is of that time.
Well, this is the issue. They gave up their nuclear weapons basically, it was the United States said, we will come support you. There will be the security guarantee. And to give up their nuclear weapons, they were supposed to have already territorial integrity. That has not been the case, and that has not been the case for years. I know we've been following this more for more than 3 years, but obviously Crimea was a decade ago. We are looking at Putin continuing to infringe on their territory, which is why this is so complicated for the Ukrainians to really digest and swallow.
That's the latest on Russia. Ukraine wanted to turn to the chip sector. President Donald Trump sealing a deal with Intel to give the government a 10% stake in the chip maker. Intel saying the government will be a passive owner with no board seat or other governance or information rights. Now, is there anything passive about this White House? This White House is incredibly active.
They are incredibly active. This is just another gambit when it comes to an interventionist approach, when it comes to corporate America. Scott Lincecum of Cato Institute comes on this program a lot. He wrote something, an opinion piece in the Washington Post yesterday, and he said the most immediate risk that Intel's decision will increasingly be driven by political rather than commercial considerations. When the U.S. government is its largest shareholder, they're going to face constant pressure to align corporate decisions with the goals of whatever political party is in power. And this is why so many people are pushing back and concerned, not just with this deal, but the fact that the President of the United States said more to come.
What a move in this sector. Intel higher by more than 2%. Let's stick with tech. Investors looking ahead to Nvidia earnings on Wednesday, hoping the results will ease fears of a bubble. Bloomberg's Tom McKenzie joins us now from London with more. Good morning, Tom. What are we looking for later this week?
Yeah, earnings from Nvidia, of course, dropping late on Wednesday, as you say. Expectations from analysts looking at this stock, they expect to see earnings increasing about 48% year on year from the previous quarter. Of course, on earnings, on revenues, I should say, of around $46 billion for the quarter. That would be a 54% increase. The question, of course, for many watching this stock is what executives, of course, Jen Huang and the team say about the China piece of this story. The earnings from the big tech companies, the mega cap tech companies, suggest that the spend continues, as you know, John. So it's less about that part of it, really, and it's more about what they have to say in terms of how they're adjusting to the China story, whether or not they are, in fact, designing a new chip for the Chinese market, and if they're any closer to getting that signed off by the Trump administration, and if indeed they think China even wants that chip at this point. Worth remembering as well, as we build up for the results, in terms of the last 2 years, there's been just one miss in terms of the last 8 quarters out of Nvidia. That was the second quarter 2025. So in terms, second quarter, in fact, I said 2022, in terms of the history of this stock, 7 times out of the last 8 quarters, you've had a beat, just one miss. Expectations, of course, will be high for this stock. It's trading not near its 5-year multiples, but it's at around 34 times forward PE. It's not looking too rich for some, but will the expectations be a little bit too stretched? I think the China story is going to be key.
Investors have been spoiled, that's for sure. Tom, thank you, sir. Tom McKenzie out of London this morning. Let's build on some of this. Frank Lee of HSBC maintaining a hold rating on shares of Nvidia, raising the price target to 200 ahead of earnings. Frank joins us now for more. Frank, good morning, sir. Let's just talk about what you're bullish on going into the print. What are you hopeful about?
Yeah. So I think going into the print, the fundamentals, the long-term story is still very solid. I think the CapEx spend, as your previous guys just alluded to, still very, very strong. But I agree in terms of, I think, this week's earnings, a lot's going to be on whether they can actually surprise the market, especially the China piece. I think that has, there's a lot of uncertainty in China. I think, so far what we've seen is, a very much a U.S.-focused response is they can't go into China. Now they got the license of H20 to come in. But I think what we've seen in the last couple of weeks is that the China government now is actually reassessing whether or not they're putting pressure on the Chinese customers, perhaps hold off on buying the Nvidia chips. So I think a big part of the guide for this week is going to be on how much of that guide will include a China piece and how much will not include a China piece.
Well, following what Beijing is telling its firms, the information reported that NVIDIA is asking its component suppliers to halt production related to the H20. So, Frank, does that just say to you that basically the H20 is done when it comes to its shipments to China?
That's a good question, Annmarie. I think, it's and certainly in the last week or two, we started to see the supply chain talk about, the shipments are being halted on an H20. I think what's difficult to assess, though, is this more of a temporary or is there something longer term? I mean, it could be part of, a strategy behind the overall trade deal, which hasn't been finalized. We do know that there is a B30 chip, a Blackwell chip that NVIDIA is potentially looking to reintroduced to the China market. But that, again, will also need U.S. government approval as well. So I think, net, there's a lot of uncertainties for this earnings, especially on the China side. I don't think we have a clear enough assessment to make a bet of whether H20 is dead altogether. But certainly in the near term, there's going to be some volatility. And this is, I think, a surprise to the overall market.
What about on the U.S. government interventionist side? We, of course, know that the president struck a deal with AMD and NVIDIA that any of these licenses that they get to sell these chips to China means they're going to have to give 15% of profit back to the U.S. government.
Yeah, so again, that's also pretty unprecedented to see this. So I think we don't know if that response perhaps is another trigger for the China government to reassess, in terms of pressure on their own suppliers, their own customers to perhaps hold off. So I think that's one of the difficulties around the NVIDIA narrative is that the China piece has really dominated headlines, but it's also very difficult to actually predict what's going to happen. So we do think that if you take a longer term narrative, the CSP the CapEx spend into 2026 is probably going to be much more important for NVIDIA longer term. But we can't escape, I think, the near-term narrative around China.
Frank, can we just introduce the Intel story into this conversation as well? I just wonder how your thoughts are developing at the moment on this matter as they look to build out foundry capacity domestically in line with the objectives of the White House. How far along are we going to be? A year from now, 2 years from now, 3 years from now, before the White House turns around and says, NVIDIA, you've got to use it?
Yeah, so I think, look, the market's obviously reacting very positively to this news of the U.S. government directly invested in Intel. It is a confidence booster, but ultimately, I think Intel itself has to execute on its foundry business, which it so far has not. So I think that's going to be the challenge: is that you can have government pressure to basically use Intel, but Intel needs to deliver first on its own execution to prove to its customers that they can produce the chips in its own fabs. And so far, they haven't really done that yet. So I think this is something we need to watch very carefully over the next couple of quarters to see what that execution is about.
In the meantime, Frank, just how at risk is their revenue in China? What are the Chinese thinking about what's happening stateside?
I think for Intel, it's they do have some exposure, but that's not where the contention is. Intel doesn't really have very much. They're not very strong in the AI space, especially when it comes to these these GPUs. So I think the majority of Intel's business today are basic traditional CPUs that go into PCs and traditional servers. So I think that's less of a concern right now. So I think for Intel, its biggest problem is they need to get back on its own execution.
Frank, do you think the Chinese government or the authorities there will be comfortable with the fact that the US has taken a stake in Intel?
I think it's something that, I think if you look at where Intel's strategies for U.S. market, I don't think there's very much the Chinese government can respond to it. I think, this is something that, if you think about the majority of the foundry business today, though, is still dominated by TSMC. So Intel's presence in foundry is still very small today. So I don't think it impacts existing businesses. But yes, there is going to be a potential perception issue. But as far as day to day, I don't think there's a big impact right now.
That's one to watch. Frank, appreciate your time, sir. Thank you. Looking ahead to earnings from NVIDIA. Frank, leader of HSBC, and how contentious the future might be for this sector.
Absolutely. Wall Street Journal editorial board was pretty scathing on the U.S. government in terms of this. And they talked about the government's support will ease the imperative of Intel become more competitive. And they're saying that basically this is one of the reasons why China's state-owned Semiconductor Manufacturing International Corporation has struggled. And they're saying in the name of competing with China, the U.S. is imitating its model of state-run business. Quote, Washington is becoming Chinatown.
Intel higher in the pre-market. Equities a little bit softer. We're down by 0.25% on the S&P 500. That's the price action. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. President Donald Trump saying the U.S. is conducting a, quote, major tariff investigation on furniture coming into the United States. Trump says the investigation will end in 50 days and imported furniture will be taxed at a rate that is yet to be determined. Elsewhere, SpaceX postponing the test flight of its massive Starship rocket just before liftoff due to a ground systems issue yesterday. The delay follows a series of setbacks, including 2 flights that blew up within minutes and another that exploded on the test stand. And finally, after 163 events and 0 wins, British golfer Tommy Fleetwood got his first PGA Tour victory at the FedEx Cup. He tapped in a putt for par on the 18th hole to win the championship at 18 under. Fleetwood taking home a $10 million surprise. And it's not even about the money. How much we can learn from this guy. The classiest individual in any sport, anywhere. The way this guy dealt with his losses repeatedly over the last several months has been remarkable. Even earlier on this weekend, when on the 15th hole, he put the ball into the water, he was still fist bumping a fence. Wow. He has dealt with this all class for months and months and months. And to be honest with you, I could not be happier for the man. Tommy, congratulations, buddy. Absolutely fantastic. Up next on the program, Chairman Powell preparing to make a move.
With policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
That conversation up next with Steve Ricchiuto of Mizuho, live from New York City. You're watching Bloomberg TV. Snapped a 5-day slide in Friday's session. This morning, pulling back just a little bit. We're negative by 1/3 on the S&P. Call it a quarter. Down by 0.3 on the Nasdaq 100. Under surveillance this morning, Chair Powell preparing to make a move.
The stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
So here's the latest this morning. Federal Reserve Chair Jay Powell leaving the door wide open for a rate cut next month. Steve Ricchiuto of Mizuho isn't convinced it's needed, writing the following. Should the Fed ease policy as the markets expect, analysis suggests the primary risk to the economy is a backup in long-term interest rates. Steve joins us now for more. Steve, good morning.
Good morning.
Just tell us, what do you think's brewing here?
Well, I think there's a bit of political pressure building. I think there's a bit of dovishness within this committee that has been brewing over years. And I think when you combine it with a misperception as to how restrictive monetary policy is, you wind up in a situation where you get a chairman making a statement like this, leaving a door open to a rate cut when he himself and his own balance of risks is completely balanced. The risk to the upside on inflation, the risk to inflation is to the upside. The risk to employment is to the downside. Well, okay, what are you supposed to do? Well, the answer is if I think it's restrictive, maybe I can cut rates. If I don't think it's restrictive, then I should be doing nothing. How do we define restrictive? That becomes the problem.
The thinking at the moment appears to be that, yes, we're facing upside risk to inflation and downside risk to employment, but the downside risk to employment are more important because the upside risk to inflation won't be as pervasive and we won't see the second round effects because of the downside risk to employment. How do you think about that issue?
You have to show me that's the case. Historically, yes, there are important transitions that take place in terms of the labor market that happen more quickly than on the inflation side of the equation. Don't argue with that. Is this one of those conditions? The answer is no. You have an economy that is fundamentally healthy. You've got an economy that accelerated or rebounded right now very, very sharply after the second quarter GDP. You've got an economy that's showing you have healthy consumer demand. You have an economy that is going to be above trend economic growth in the current quarter against the backdrop of a consensus forecast of 0.9% growth. And so therefore there's a disconnect between the reality and the perceptions. And I think that's part of the problem. The other thing, I think when you're looking at the coverage of this, everyone's focused in on the opening up the door to a rate cut. The chairman said a couple of things. One was that basically that he didn't think policy was that restrictive, yet the market has 5 rate cuts priced in. That's number one. Number two, if you look at the framework changes, everything they did in 2020, which was adopting a Keynesian style of monetary policy, is gone. And they've readopted a Taylor rule approach to monetary policy, which is a symmetric monetary policy guide frame. And when you look at the Taylor rule type models, monetary policy is not restrictive.
So you mentioned, though, at the start, because there's one other dimension happening here. You said it is a little political. Do you think his speech Friday was political?
Well, I think they may get into a situation where the chairman said, okay, I'm going to open the door to it and let's see what the committee does, because there seems to be this perception inside the White House, inside the Treasury, that the chairman can determine where monetary policy goes. So if the chairman opens the door to a rate cut and the committee votes and doesn't vote for a rate cut, then guess what? It's not just one vote.
Bob Elliott was saying that he potentially was doing this to protect the Fed as an institution. But it sounds like what you're saying, he's protecting himself.
Well, again, protecting the Fed as an institution. Yes, the institution seems to be under attack, but it's always historically been under attack. We went through a very, very calm period, where we did not attack the Fed from basically Paul Volcker on. We're now back in the more political environment of these things, and we've historically faced these dilemmas. I think the real issue for the Fed in here is not just maintaining its independence, but maintaining its credibility. Okay, what is your framework? Is your framework a symmetrical monetary policy? Okay, if it's a symmetrical monetary policy, then live up to the symmetrical monetary policy. If it is still a policy skewed towards the labor market issues, i.e. it is the more equal of two equal framework or guidelines, then be clear about that. And this, I think, opens up the bit of the dilemma for what we're dealing with today.
Do you think we could see a repeat of last year? They drop rates at the front end and we start seeing problems at the long end?
I think that's really the underlying risk that they face. Now, again, could that be then a message to people on Capitol Hill that believe, well, if you lower short-term interest rates, long-term interest rates automatically come down? The answer is yes. That may be, what has to happen to get it done. Is 25 basis points going to matter one way or the other? No. Will 125 basis points matter? Yes. And that's really the difference here. I don't really care if they cut rates 25 basis points in September. I care about what they do with the dots. Do they now look at their different framework and say, okay, we're back to the pre-2020 framework. Well, what should the dots then be going forward? Should the dots still be for the number of rate cuts we envision against an environment where we have an economy that's going to continue to grow and we have inflation in our forecast that's 100 basis points above our target?
Steve, this is really important. What I hear from your analysis is a clear distinction between whatever they do on September and then the rest. Yes. And the rest is far more important. Do you see scope then for a hawkish surprise on the 17th?
Well, the problem is the dots, because the dots aren't set as part of policy. They go into the meeting having delivered their dots and their SEP, and therefore it's just a calculation. So, and unfortunately, the market only pays attention to the dots. It is the intellectual gravity well, okay? Once you put that dot out there, all thought process in the market goes to explaining that dot and forecasting what's going to get that dot to happen. Nobody thinks of anything else outside of how does that dot get validated. And that's where the market is. So as long as those dots run the risk of being there, I think you might wind up with a greater divergence in the dots in September. And that may be the thing that matters.
Steve, it's good to see you, as always. No doubt we'll see you before then. Anyway, Steve Ricchiuto there of Mizuho. September 17th, that decision less than a month away. This is still a divided Federal Reserve, and you've heard that from Steve just then. You've heard it from others too.
Divided Federal Reserve, a lot of questions whether Steve Myron will be there at the next Fed meeting. Of course, can he get Senate confirmed in time? What Steve had to say that was interesting, the chairman is opening up the door, almost a reminder to this administration. The chairman said he's willing to cut rates. Reminder to them that this is a deliberative body in order for them to walk through that door and deliver that rate cut.
We've got a lot to get through over the next few weeks. NVIDIA reporting later this week. Then on to next week, we've got a payrolls report just around the corner. Then it's CPI. Then after that Federal Reserve decision. Coming up next, Dan Skelly of Morgan Stanley. Plus, Henrietta Treyz of Veda Partners, the former Kansas City Fed President Thomas Hoenig, and Robert Tipp of PGIM Fixed Income. From New York City, the second hour of Bloomberg Surveillance. Up next.
This is an environment that is very volatile.
It does seem that stocks are expensive relative to what I call fundamentals.
Stocks have done so much better than bonds over the past several years, and that gap's going to close.
The market is overly sanguine about where this neutral rate is going to settle.
The market has decided that there's almost certainly going to be a rate cut.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
3-week winning streak on the S&P 500, believe it or not. The longest weekly winning streak of the year so far. It's been choppy, hasn't it? Back and forth, snapping a 5-day slide in Friday's session on the S&P 500. Your scores look like this morning. We're down by 0.3% on the S&P. On the Nasdaq 100, we're down by 0.4. In the bond market, switch up the board. 2-year, 10-year, 30-year. My focus on the long end of the curve. The chairman's anchored the front end, the 2 years at 371. What happens at the longer end of the curve? Steeper this morning at 4 basis points, 491.82. As we work our way through the week, it's all about the earnings from Nvidia. Then later on in the week, closing out the week on Friday, core PCE, setting the stage for looking ahead to the data in September.
And that's what Steve Ricchiuto was talking about, the fact that the data could surprise potentially and mean the Fed needs to walk itself back. I find what Steve was talking about so interesting when it comes to Chairman Powell, because Bob Elliott was talking about the fact that maybe this speech did have a hint of politics to basically get some heat off the FOMC, get some heat off the Fed from this White House. But what you heard from Steve Ricchiuto was almost get some heat off the Fed chair only himself. He's the one that's open to potentially a rate cut right now. It's a deliberative body. Does everyone else line up with him in September?
Things are still super finely balanced here. A lot of people believe the chairman has solidified that rate cut in September, but they've got to put out some projections, and this is what Steve Ricchiuto was getting into. This is a market looking for more than just 25. It's looking for 100 more than that. Is this Federal Reserve going to reinforce that in forecasts in a few weeks' time?
And how much is the market, obviously what he said, is going to pay attention to those dots. What's so interesting is that Powell's talking about that the goals of their dual mandate are in tension right now. But what Steve is saying is obviously there is a bias to the labor market. That's how they are acting, but that's not what they are supposed to be doing. So he just is asking for some clarity from the Fed.
Super focused on the long end of the curve. We'll have more commentary on that throughout this hour. 30-year bond yields this morning at 4 basis points. Coming up this hour, Dan Skelly of Morgan Stanley with stocks very close to all-time highs. Henrietta Treyz of Veda Partners with trade negotiations between India and the United States underway. And the former Kansas City Fed President Thomas Hoenig as investors prepare for rate cuts. We start this morning. We begin this hour with stocks inching lower after Fed Chair Jay Powell opened the door for rate cuts. Dan Skelly of Morgan Stanley writing, despite dovish takeaways from Jackson Hole, we think a more hawkish outcome for policy could disrupt market expectations. Dan joins us now for more. Dan, good morning.
Morning, John.
It's great to see you. Let's just build on that quote there. What are you expecting?
Listen, we've all year expected no rate cuts. And so notably, as Annmarie mentioned, that data set of the last couple of weeks is starting to challenge that, particularly on the labor front. But having said that, I would just say expectations are super elevated. We're now 85% priced for a Fed cut in September. The rally since April has been fundamentally biased with Mag 7 on better earnings. But also when you look at the junk cohort in terms of cyclicals, higher beta, some of the unprofitable tech, they've screamed higher. And so I would argue that it's beginning to look a little asymmetric. If it's really priced and you get a rate cut, does the market continue to rally further? If the Fed doesn't cut, that could also be disappointing.
Don't you think the Federal Reserve's reaction function right now is also asymmetric? If employment holds up, they don't hike. But if it gets worse, they do cut. Isn't that a good thing for equities?
It could be, but John, again, the valuations stay at 22.5 times forward earnings on an earnings front that we do not think are inflecting higher, still looks stretched. So we think a lot of that's already in the price.
So if they were to cut in September, do you think he comes out in the commentary is more hawkish?
He definitely could. And I think the reality is, just going back to one of the boogeymen that we have yet to see yet, the tariff-related inflation data, we have a unique advantage, and I would say perspective as advisors to wealth managers, in that we talk to a lot of business owners. And the business owners that we talk to right now on the private client front are saying that they are starting to put in pricing for the first time this year. And so we would, again, argue that the inflation from tariffs has not yet happened, but it's on the way.
How uneven is it? McDonald's last week was talking about how they're cutting some of their meal and making them more of a better price point. At the same time, PepsiCo is saying actually they're hiking some of their carbonated drinks. So is it uneven? When do we finally get almost, you can call time, when tariffs have actually have been digested into this economy?
Phenomenal question. And so a couple of things. Historically, if I go back to Trump 1, 2018, 2019, it took 6 to 9 months to see really the effects of tariffs and some of the goods pricing. Number two, to your point, Annmarie, which is a great point, it is really uneven across a spectrum of different business models. Let's face it, the Mag 7, 35% of the index, plus financials, 15%. My simple math gets me to half the index doesn't really have big P&L risk from tariffs. But when I look at the S&P 493, the market of everything else, there's a lot of businesses in tech hardware, consumer retail that have really yet started to see that pain. And again, we would say that's coming. If you look at the first half of this year, it was really defined by two things. First, a lot of countries were negotiating with Trump. We think the baseline expectations have really started to narrow to a 10 to 15% baseline tariff. So all of the countries who were eating tariff costs earlier in the year in their negotiation phase don't have that incentive anymore to do so. Number two, companies did this, as we've talked about, massive pre-buy. So a lot of companies were eating the tariff costs as well. We think that phase has also ended.
Dan, just extend that thinking just a couple of steps further. If that's ended, what are they going to do? Pass it on to the consumer or cut costs themselves, which causes a much bigger employment problem?
Here, a great point. And here again, we talk about the tension, right? The tension between growth and inflation. And I think that's a perfect manifestation of that particular scenario. And so, John, the best I could say is the survey work that we have at the firm shows that about 30 to 40% of companies surveyed are talking about pushing on price. Now, it's not going to be a full pass-through. It's probably going to be a 70 to 80% pass-through. But even such, we haven't seen any of that in the first half of the year.
So just talk to me about what kind of levels of inflation you're expecting and how sensitive you think the Fed will be to it in the months and maybe year to come.
As the Fed indicated in the Powell comments over the last couple of days, they think inflation from goods is very much going to be ad hoc and one-off, okay? Having said that, I think the bigger point that a lot of people are not talking about is how much services inflation firmed up in the last couple of months as well. And lastly, we have yet really to see the full impact of the immigration and deportation impact on wages. And so we think that's also coming. So to answer your question, John, it's probably a 3.5% inflation level over the next year or so that is going in the wrong direction from their goals.
But Powell was talking about the fact that the tariff impact won't all happen at the same time. So what does this mean for the next 12 months?
So, we also agree. So we would say you're going to have this kind of ramp up, and we start to see elements of that. It's probably the next 2 to 3 months where that happens and then starts to fade in the first half of next year. But to John's point earlier, what's the kind of second order effect of that in terms of growth, right? We've had this massive wave of consumer spending for a long, long time. We don't expect that to continue into the perpetual future next year. And so we would expect to see a little bit of a growth slowdown in the beginning of next year.
So next year, you think consumers actually push back on higher prices?
Well, you're seeing it already. You're seeing it across different business models. And you alluded to this earlier. If you're a big U.S. multinational with scale and pricing power, you may be able to put through some pricing, right? If, however, you're in an area that has structural challenges, you mentioned a consumer staple company earlier, and maybe you're losing market share and you really don't have many other options but to hike prices, you may have to elect to do that. But we're just seeing this massive bifurcation, Annmarie, and you noted this earlier. Even huge companies like Amazon and Walmart are having very different pricing scenarios and pricing approaches to how they're dealing with tariffs. And so it really is more of an idiosyncratic bottom-up type analysis.
So can you describe your approach to equities, given that backdrop?
Absolutely, John. And candidly, I've been saying to sell above 6,000, so I've been early on that call / wrong so far is how I'd probably redefine that, but not too far off. But I would say, aside from that market level commentary, the sector and the thematic calls have worked well. So we continue to like financials. We continue to like parts of the AI infrastructure across industrials, electrical, parts of energy infrastructure. That's done very well. And lastly, one call that we think on a little bit more defensive perspective, which is healthcare. We think healthcare today, trading at the second percentile in terms of its historical valuation, is at or past the point of maximum policy fear and is starting to look more attractive.
Can I pick up on the first one? Banks. Why do banks work, given everything you've described?
So it's interesting. We've seen positioning in banks really change over the last several months. People have actually been better sellers of banks. So I would say positioning today is not really that full on the institutional front. But number one, we are playing a steeper curve, which we have been for the better part of 6 to 12 months, which has worked well. Number two, we think that you're going to continue to see at these levels of market excitement and sentiment, capital markets recovery, which certainly ramped up in the second quarter and is continuing into the third quarter across ECM and M&A. And lastly, deregulation, right? This is an area of the market that should benefit really well from deregulation tailwinds.
Steeper curves, seeing them this morning, that leakage on the 30-year, not just stateside, but we've said this continuously worldwide. Can we finish there? What is happening at the long end of the curve? How unanchored has that story become from the debate at the front end of the curve? Just what is going on there?
Yeah, so look, we would just say that, and we've continued to position this way, we're more nervous about the long end. Term premiums, John, as you know, have creeped up over the last year or so. We still have to fund the big, beautiful bill, so there's going to be more issuance out there. We talked a minute ago about rising inflation expectations across goods and services. And then just lastly, globally, right, we've already started to see people position away from long bonds in U.S. Treasuries. And so it's interesting that the demand for U.S. stocks, namely Mag 7 and some of our unique technology assets, has continued really strongly, but it's not the same story for the bond market.
I keep going back to this. It's the UK, it's Japan, it's the United States. How problematic is it? And do you see it, and we keep going back to this question too, do you see it as a replay of what we saw at the end of last year? Is this somehow different or the same?
I think the thing that's different is the market has more clarity and certainty that there is flexibility amid the White House, right? Like April 1st, April 2nd, we didn't know that. April 10th, we did know that. And so I would argue that there was some fear that this was an administration that was willing to hold its reins on the policy, the extreme policy pronouncements very, not thinking about the market impacts, and now we know more about that.
What's the corrective course to a 30-year at 490? What do they do? The bill's been published, it's passed, the one big beautiful bill. How do they correct course?
I'm not sure how they correct course. I think at this point you have to bet on the fact that we're going to grow our way out of some of these debt issues. And if you double down on some of our industrial competitive advantages with technology, as we're seemingly doing, is you deregulate. Hopefully those are the tailwinds to help the growth algorithm grow your way out of the debt.
Or you raise enough money through tariffs. S&P Global ratings last week coming out with a bit of an endorsement for the amount of money that was being raised.
Well, exactly. They continuously say the reason why we can afford this bill is because we obviously don't want American taxpayers, their tax bills to go up, but it's the tariff money coming in. Also, what else are they doing? They're asking NVIDIA and AMD to give them 15% of their profits of chips going to China. And what did they say? That's to bring down the deficit. Scott Besson said it right here on this program.
Fascinating moment for financial markets worldwide. Dan, it's good to see you, sir.
Likewise.
Thanks for breaking down your thinking. Dan Skelly there of Morgan Stanley Wealth Management. Bond yields this morning higher by 3 basis points at a very long end of the curve, about 491 so far this Monday morning. That's the price action. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Vice President J.D. Vance says Russia appears to be softening its stance as American sanctions against Russia remain on the table. This as the Trump administration attempts to broker an end to the Russian war in Ukraine. Elsewhere, Starbucks is cutting production at 5 of its U.S. coffee plants. Sources telling us here at Bloomberg the plants that roast and package coffee will now operate 5 days a week instead of 7. The company is cutting costs in some areas to pay for upgrades elsewhere. And finally, K-pop Demon Hunters topped the North American box office. According to Variety, the film is projected to gross $18 to $20 million over the weekend. It's a rare win at theatres for Netflix, which released the musical as a one-weekend-only sing-along event, which sounds like absolute hell to me.
Unless you like K-pop.
Unless you like K-pop.
Blackpink. I like some K-pop.
So you'd enjoy a sing-along at the movies?
I think I'd go see this.
Okay, all right. Good for you. Okay. Up next on the programme, continuing trade negotiations.
What is the net impact on the Americans because of our trade with India? They have higher tariffs, higher non-tariff barriers. We run a massive trade deficit with them, so that hurts American workers.
A conversation up next with Henrietta Treyz of Veda Partners. Live from New York City this morning. Good morning. live from New York City. Welcome to the program. Some changes on the Federal Reserve. Deutsche Bank now looking for a cut in September. BNP Paribas likewise. This from Bank of America. We see a risk that the Fed could make a policy error by cutting just as activity rebounds with inflation headed to 3%. The latest from Aditya Bave and the team. If you are just joining us, welcome. Equities at the moment just about negative by 0.2% on the S&P. On the Nasdaq, down by 0.3. In the bond market, yields higher across the curve, up 3 on 30s, 490 on a 30-year bond yield so far this morning. That's the price action under surveillance this morning, continuing trade negotiations.
What is the net impact on the Americans because of our trade with India? They have higher tariffs, higher non-tariff barriers. We run a massive trade deficit with them, so that hurts American workers, hurts American businesses. Then they use the money that they get from us when they sell us stuff to buy Russian oil. That's insane.
Here's the latest this morning. India's ambassador to Russia saying it will continue to buy oil wherever it gets the best deal, following President Trump's threatened penalties for buying Russian crude. The statement comes days before President Trump's 50% tariffs on India take effect on Wednesday. Bloomberg's Tyler Kendall joins us now for more. Good morning, Tyler.
Yeah, hey, John, good morning. Well, at this point, we haven't gotten any sort of indications from the White House that they're going to let up on that 50% tariff threat, as it appears that India is digging in its heels. And we know that that discount on Russian oil does help India secure energy supplies and keep domestic prices low, which are important to its growth, which is why our analysts at Bloomberg Economics say that when New Delhi does the risk-reward calculation here, there's no guarantee that the White House would give in any sort of trade concession. So at this point, they're going to keep importing those Russian energy supplies to both maintain its autonomy, but also to balance alliances here, which is something that we know India has been doing since the beginning of the Trump administration at this point. Also important to point out, though, John, that India has said that they're being unfairly singled out when it comes to these so-called secondary tariffs. We could point to how China, for example, is the top importer of Russian crude, though if you ask White House officials, they'll tell you that those negotiations are, of course, on a totally separate track. So at this point, they're not going to make that same sort of so-called secondary tariff threat. But you'll recall that this really is quite the reversal for India. This is a country that had long been prioritized in these trade talks, made concessions early and often was our understanding. But it does appear that there has been an impasse, particularly when it comes to U.S. agricultural products. And that stalled these trade talks well before President Trump ultimately made that secondary tariff threat of now raising these tariffs to 50% come Wednesday. John, I'll just quickly add that we did have some new reporting out from Bloomberg News this morning that India's embassy in Washington has hired a top lobbying firm with close connections to this White House in a bid to try to advance these talks. And we did see perhaps some indication of progress over the weekend by the fact that President Trump did nominate a U.S. ambassador to India. That position has been vacant since the Trump administration took office.
Tyler Kendall with the latest. Tyler, thank you down in Washington, D.C. Let's build on this. Henrietta Treyz of Veda writing sectoral tariffs will continue to rise and expand, likely through the remainder of President Trump's second term in office. Henrietta joins us now for more. Henrietta, good morning and welcome to New York City.
Thank you. Happy to be here.
Hey, it's good to see you. Set us up for the rest of the week. What are you looking for?
Well, I'm looking for the U.S. Open. My little brother is a coach, and he's playing tomorrow, so I'm very excited.
Awesome.
I'm very excited. But otherwise, this is a really critical week. The plaintiffs in the case about IEEPA and the president's authority to maintain all of these tariffs, whether it's the secondary tariffs on India or any of the others that he's put on, is up for debate and could potentially get a ruling from the Court of Appeals this week. So lots of really exciting stuff to watch there.
The entire tariff strategy is tethered to using IEEPA. So if this gets struck down, where does that leave the policy?
Well, what I've been advising clients is to say, watch and see if the president starts launching new Section 232 and 301 investigations, because those are not being challenged by the courts in any kind of comprehensive way. So the biggest sign of an indication that the Department of Justice is fearful that they're going to lose this case is if they start launching new investigations. And what happened last week, we got two of them, one on wind turbines and another on furniture. That is every indication to me that we're about to see more tumult in the tariff space than we did in the first half of the year, which is a lot to say, I admit. admit.
So instead of going country by country, it goes after industry in different sectors. But how long does a 232 or 301 investigation actually take?
That's a great question. So ordinarily, you have 270 days to conduct the investigation. You get another 90 days to give your recommendation to the president. He has 15 days, yada, yada. But what's happened in the last couple of months is that he's started to truncate that schedule. So the copper investigation, for example, took 4 months from start to finish. And this latest furnitures investigation is going to take 50 days. So there's no comfort that anybody should take in, hey, this could be a year-long thing. It could also be 1.5 months.
We have 2 tariff deadlines this week. We have India with 50% and also the de minimis loophole ends on Friday. What are you looking for?
Well, I think first and foremost, this should be an indication, especially to the Fed, that tariffs are not a one and done event. They are constantly rotating. We've done this de minimis thing, 3 times this year? Now we're getting, and now we're getting the India tariffs are secondary tariffs that go on top of the 25% they've already gotten in the last month, on top of the 10% we got at the beginning of this year. This is a constantly rotating stream. And if IEEPA gets disrupted, then we're, bar the door. We're going to get tariffs on every sector. And we still have them coming on pharma and semis and critical minerals and all the rest.
Walmart talked about this last week. Tariff costs are going up every single week and potentially for the foreseeable future.
And it's hard to really paint the picture and as a company figure out what's going to happen next. If something like, to Henrietta's point, IEEPA gets struck down in the courts, then they have to go through all of this again, but find a different way to go about it.
Well, you mentioned companies. Apple is the one that's of interest to me right now, shifting some production to India to produce iPhones for consumption all around the world. What does Tim Cook know that we don't about what's going to happen with tariffs on India?
I mean, I don't know that there is any great information except for maybe it's a better opportunity than China. I think if you had to compare the two, the China tariffs are already under Section 301. The second that IEEPA gets struck down, the president can just swiftly migrate those over to 301. So those are ready to go. With India, I have all year expected a Section 301 investigation into India wholesale. And I suspect that if IEEPA gets struck down, that will come next.
What draws your attention to India specifically?
A lot of an understanding of the president's first term with India. They stripped them of GSP immediately. There are a number of issues and a lot of support from senators in Capitol Hill from both sides of the aisle on everything from, their critical minerals that go in and chemicals that go into pharmaceutical goods to their call centers. So it's almost like the scale of how much of India is a problem on different segments, H-1B visas. You can really go on. And I think that's what poses a significant threat from India specifically.
But we've seen both political parties court India to use to bolster against China.
Right.
Where does that leave that policy?
Well, I think that this administration is constantly shifting things around, and they're not willing to say, hey, come join us. We want to join up against China. I think that was a Biden-era strategy. I don't see it right now. Certainly not. And I think India is just getting more and more.
But it was a Trump 1 policy.
It was a Trump 1 policy. But they weren't as aggressive with tariffs then. Now they're going wholesale. We need, are we up to $3.5 trillion worth of tariff revenue? I mean, it's different.
It's a lot of money. Let's put it that way. Do you want to give little bro a shout out before tomorrow?
Hey, Bo.
Who's his player?
Brandon Holtz.
Very cool.
And they are playing tomorrow afternoon, and we'll all be there.
Great.
Really exciting.
Best of luck.
Thanks.
Give us an update. Thank you very much. It's good to see you. Thanks for dropping by. Henrietta Treyz there, Veda Partners, not here for us. Slightly offended. Here for the US Open.
That's exciting. I mean,
very cool.
I think playing tennis has to be incredibly stressful. But imagine being the coach. I think that's almost worse.
Don't you get stressful watching? I get super stressed.
I'm so excited.
Very stressed out. Are you? Good. That's good. When I have a tennis player that I'm backing, I get super stressed out.
I know this because I've been to the US Open with you. This is why you've now, in your older age, have switched to golf.
I've mellowed. Yeah. I'm just sort of like pushing all the sports that get me stressed out to one side. Football, tennis. Okay. Up next on the programme, we'll catch up with the former Kansas City Fed President, Thomas Hoenig. Plus, we'll touch base with Danny to get your morning movers. Verint Systems surging on news it may be acquired. That stock is up by 12.6%. From New York, this is Bloomberg. Live from New York City, welcome to the program. Equity futures negative by 0.2% on the S&P. Snapshot of the price action looks like this. So far this morning, down by about a third on the Nasdaq 100, the main event for the Nasdaq a few days away. Earnings from Nvidia to round out earnings season. Turn to the bond market, 2-year, 10-year, 30-year. The 2-year got lots of attention on Friday as Chairman Powell left the door wide open for a rate reduction in September. Still just around 370 on 2s, yields up a single basis point. The focus at the moment, no drama yet, but this is the focus, I think, for a lot of you in fixed income. What the 30-year does here. Up 3 basis points this morning, 490. The spread between 2s and 30s got to about 120, 121 earlier on this morning, trading about 118, 119 at the moment. But that curve was steeper Friday. Yields up by, let's say, 6 basis points steeper. 2s versus 30s on Friday, and up another basis point or so far this morning. The distance between the two getting a little bit wider. Steepest curve going back to early 2022. That's the price action. 2 hours away from the opening bell. Let's get you some equities, some morning movers with Danny Berger. Hey, Danny.
Hey, John. Starting our Monday morning off with a little bit of coffee news. Keurig Dr. Pepper will be buying the Amsterdam-listed JDE Peet's, continuing a string of mergers and consolidation in the beverage industry. Now, as part of this, once it's complete, Keurig and Dr. Pepper will separate again between their coffee and their other beverage business, undoing what happened 7 years ago when the two merged together. The choir often falling with these types of deals and the complicatedness of it, those shares down 4.5%. Now, also after the bell on Friday, we learned that the U.S. government would indeed be buying a stake in Intel, just under 10%. President Trump talking about that, touting Intel shares of the company are moving higher by 1.6%. Intel saying that it's a passive stake, that they won't have any voting or governance rights of the company. Bernstein pointing out, though, yes, it needs money, but it also needs customers. Now, finally, another take private likely going to happen. Another one, I should also say, from Thoma Bravo after that massive Dayforce one last week. Today, sources telling Bloomberg that they are looking at Verint Systems to take this company, this B2B software company, private. Shares are up 12%, and it would value them at about $2 billion. John.
Danny, thanks for the update. More from Danny in the next hour. On our radar this morning, President Donald Trump meeting with the South Korean president at the White House later today. High on the agenda, South Korea's $350 billion U.S. investment and a trade deal that includes 15% tariffs on imports to the U.S.
So obviously they'll be talking about the latest trade deal that they signed, this economic opportunity, but really I think security is going to be in focus now that trade is behind them. South Korea really wants to make sure they are diffusing this tension with North Korea, and they're going to want to make sure Washington is lining up with them. And at the same time, the president has made it very clear they want to see South Korea spending more when it comes to defense. I believe they're at 3.5%. He wants to see them come up to 5% because we have 28,000 troops stationed in South Korea. South Korea pays about $1 billion. The president has already said he wants to see that going to, say, $5 billion. So I think security is going to be really in focus today when these two leaders meet.
Just a note on these investment deals. Do we know with any real clarity, detail, how these are going to work?
Well, we have the top line figures, but when it comes to what is going on with all of these trade deals that the president has spoken about and these deals that were technically signed, the teams are still working through them. And we have the team still working through South Korea. We have this team still working through what's going on in Japan, what's going through the European Union, what's going through Canada, Mexico, India coming up on Wednesday. And all of this, to Henrietta's point, may be struck down in the courts because they are using IEEPA as the legal authority to go about this tariff policy.
You mentioned India. Let's talk about India. Tyler mentioned this story a little bit earlier this morning that India's embassy in Washington is hiring a lobbying firm with ties to President Trump as the Wednesday deadline for 50% tariffs looms. The levies are punishment for New Delhi's continued purchases of Russian crude.
So I think when you go out and you get that fancy lobbying firm that has close ties to this administration, you're basically admitting that you are not further enough along that you wanted to see. India was supposed to be one of the first ones out of the gate to strike this deal. Now they're having a lot of problems with this administration. We have seen Peter Navarro in the Financial Times verbally to the press talk about the fact that a lot of this has to do with the fact that they are buying Russian crude. It makes it different from China because China was always buying Russian crude. It was this opportunistic moment that they said India has been able to go after when it comes to cheap Russian crude, refining it and then sending it off to the rest of the world. I'm focused on geopolitically. What basically we have seen over the past few weeks is India have a top Chinese official come. Modi is going to be meeting with Xi Jinping, and we've seen them actually, at least in rhetoric and maybe with some deals, go towards more of these BRICS countries as they're having this feud with the United States.
Wouldn't it be more effective to point to the Europeans and how much Russian energy the Europeans are still buying?
They are still buying, although, I mean, Christine Lagarde over the weekend was talking about the fact that they had to diversify. They were forced to. But when they are diversifying, it's not just from the United States, LNG, which the president talked about in his first administration. He wanted to see, freedom molecules, more of them going to Europe. Europe's actually buying the refined crude from Russia that India is refining and sending it back. So it is one kind of silly cycle.
It's super messy. Very serious, but super messy over the last few years or so. A top story worldwide for financial markets, of course, is Chairman Powell teeing up rate cuts in September and maybe beyond. Traders now seeing an 84% chance of a cut next month after Powell signaled that the central bank may ease before inflation fully returns to target. Want to stay on top of the Federal Reserve. Joining us now is the former Kansas City Fed president, Thomas Hoenig. Thomas, welcome back to the programme, sir. You, I'm sure, read over that speech as well as listened to it from Chairman Powell on Friday. What was your major takeaway?
Well, I would say that he has opened the door for a rate cut in September. He's still referring to the policy rate right now as restrictive. That may be debated, but the fact is that's what he's saying. There's an increasing concern about employment, especially with the changes in immigration and so forth, that they're focusing now on the possibility that the unemployment rate now, if it went up, if people began to be laid off, the unemployment rate would go higher. That has them nervous. So that's why I think he opened it up.
Thomas, just on employment, could you give us your impression of how things are developing? The chairman called it curious, and it is curious what's happening here. We've had a step down in both supply and demand. How much weight should you put on one versus the other?
Well, I think he's got a point. And I think part of the reason at the conference that they had the conference was about labor. And one of the things that's going on is not just this immigration policy, but the fact that the demographics globally are changing. We're having a slowdown in fertility rates. That is changing the market. And in talking to some of the labor economists at that conference, they're saying that, the real increase on a monthly rate, if it were to be 40 or 50,000, that wouldn't necessarily be a particularly bad outcome given the changes in the dynamics in that labor market. So it's yes, it is curious, but it's also reflecting real change going on globally in the structural population trends going forward from here.
The last labor report and the revisions were not great, and that's clearly why you're seeing the Fed chair open up this door to September. But they continuously miss their inflation target. Why is the bias to the labor market?
Well, that's my question as well, because inflation's 3%, in my opinion, at least, and that's well above the 2% target and well above price stability. So I was a little taken back by the fact that he emphasized the employment side when we have this dynamic going on in employment, and not ignoring, but downplaying the very, I think, significant inflation and referring to policy as modestly restrictive when in fact there's an argument that the real rates at 1.5% are fairly neutral, at least.
Well, Thomas, then that led me to my next question, which is, was the chairman's speech political?
Well, everyone thinks not. I would know, only he would know inside. But I mean, there's a strong support that the fact that he's staying independent, that he made very clear they're going to keep price stability as an important goal. But I think it does raise questions in people's minds, of course, and that's the circumstances we're in, number one, and number two, the bias in his speech that gave people a little bit of a setback. So we'll just have to wait and see how it plays out.
Jonathan and I were talking earlier in the program how basically this is Chris Waller's view of the world. It was almost like Governor Waller wrote this speech. Do you think this is actually how Powell feels, or do you think that he is forming consensus amongst his colleagues?
Well, there's probably a combination of that. I think he is trying to build consensus. We clearly know that there is different views within the committee, not seen for quite some time. So he needs to build consensus. But I still would think that in those circumstances, even he would want to play it more neutral in his speech. But I think there is a lot of pressure coming from both Chris Waller and Mickey Bowman on that, and he's aware of that. So he has to walk this tightrope, as you will, as he approaches September. And I think he'll be looking very carefully, and I think other members of the committee will be looking very carefully at the inflation numbers that come out next, and watching the employment numbers very carefully, because that that will, I think, tip it one way or the other if they are out of line with expectations.
So at the end of the day, Thomas, once again, is this just a Fed that's data dependent? We have PCE this Friday, one more jobs report, and obviously one more CPI report before they meet.
Right. It's data dependent, number one. And there is, look, let's face it, there's an enormous amount of pressure on the Fed from the administration right now. That cannot be ignored. In fact, even the presidents are talking about being put at risk right now because their reappointments come up next year. If you do get a takeover of the board, how will that play out? So there's an enormous amount of pressure on the Fed right now that cannot be ignored. And I think the public has to be aware of that, and certainly policymakers have to be aware of that right now.
Thomas, are you yourself worried about Fed independence?
I am. I think we haven't seen pressure like this since Johnson and Nixon. It's very significant, and it's more direct. It's more public. It puts the Fed in play in a lot of ways, both on the market and in public's eyes. So, yeah, I'm very worried about it, to be honest with you, yes.
Hey, Tom, you're not the only one. Not the only one over in Jackson Hole, that was for sure. The former Kansas City Fed President Thomas Hoenig there on the Federal Reserve Chairman Powell, and just a final note on central bank independence.
And what's interesting there is he said we haven't seen this since the Nixon times. But what happened during Nixon and Arthur Burns was, of course, the fact that this was all happening, Jonathan, under the table almost. This is overt, which almost in itself, the public then realizes that this is what the White House wants as an outcome. And in that sense, at least there's more transparency because you actually see some of the pressuring and the jawboning that's happening on the Fed.
Look, I understand the concern and I understand where it's coming from. I just say at the moment, just look at the names that are being lined up to replace some of the individuals on the Federal Reserve. Look at the list to become the next Fed chair. That is a list filled with very credible candidates. Now, whether you think that's just there to massage the optics of the situation and they're going to go with someone else who's less credible, I don't know. But I can only take the list for what it is right now, and the list of those names is highly credible.
It's incredibly credible, and also it is bipartisan. It is diverse in thought when it comes to individuals that were maybe appointed by the Biden administration and individuals that were appointed by Trump when he was first in power and under Trump 1.0. And then you come down to it and you think what Wall Street really thinks who it's going to be is someone like Christopher Waller, who seems to not only been winning the argument on Wall Street, but he seems to be winning the argument in the room based off of Jay Powell's speech on Friday.
That's the latest on the Federal Reserve. If you are just joining us, welcome to the programme. The latest on the market, down just a little bit. No drama here. We're negative by about 0.25% on the S&P 500. That's the price action. Here's an update on stories elsewhere this morning. With your Bloomberg brief, President Trump taking game at NBC and ABC, saying they are, quote, the worst and most biased networks in history, adding that he would support the FCC in revoking their licenses. Elsewhere, thousands of homes in Northern California and Oregon are under evacuation orders, and warnings as the picket fire burned through over 6,800 acres. The blaze is only about 11% contained, according to CAL FIRE. And finally, Chinese Taipei wins the Little League World Series for the first time since 1996. They beat out the team from Nevada 7-0 in Williamsport, Pennsylvania yesterday. Chinese Taipei's pitcher dominated, giving up one hit in 5 innings. Very cool. Up next on the program, opening the door to rate cuts.
With policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
That conversation up next with Robert Tipp of PGIM. Live from New York City, this is Bloomberg. The last week of August, where did that go? Equity futures on the S&P 500 negative by 0.2%. On the Nasdaq, we're down by 0.3%. Under surveillance this morning, opening the door to rate cuts.
The stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
So here's the latest this morning. Bond yields plunging on Friday after Fed Chair Jay Powell signaled a possible rate cut in September, ending an 8-month pause. Robert Tipp of PGIM writing, the attention to the growth side of the Fed's equation is also a welcome development, suggesting the Fed is attuned to downside economic risk. Robert joins us now for more. Robert, welcome to the programme, sir. Let's just reflect on what we heard from Chairman Powell. What is he setting us up for going into year end?
I think he set us up for doing whatever the data told him to do. You know, he opened up to rate cuts with one sentence. You know, before that sentence, he was talking about inflation and the concerns on the inflation side, which are very real, frankly. You know, he got it wrong on the data, and he really pounded the table at his last press conference about how decent the labor market was and they weren't cutting. And then he got, 3 months worth of bad data in one go on that Friday. So he opened the door to the rate cuts. If they get another ratification of the weak data, he's opened the door. They can cut rates. He can work with his committee. But he bought time, and he bought the ability to act independently because the Fed is not independent. They have to be very careful.
Robert, he also redefined what weak data actually was. We'll get to central bank independence in a moment. I want to sit on the labour market. Last time around in the news conference, he talked about the labour market being solid and anchored that view around the unemployment rate, almost that data point alone. And now he's looking at a simultaneous step down in the supply side of the labour market and the demand side and putting more weight on one versus the other. And I'm just wondering, Robert, where you think that's come from.
Yeah, I think that data is incredibly light in terms of sampling. I'm not a statistician. I'm not an economist. But it's not that many households. It's not that many businesses. And so you need a couple years before that data begins to settle down with all the revisions. And so if you add, subtract, and God forbid, start dividing those numbers and getting unemployment rates, you have a tremendous amount of risk in interpreting those. So, I think the economy is doing reasonably well. But to his point, when you get downward revisions, they tend to have positive serial correlation. You tend to keep seeing them. Some research says, that doesn't correlate with recession. Some shows that it does. And I think you and I know that often with recessions, you look back, they say, oh, yeah, 6 months ago, we were actually in the recession. We didn't know it. He's feeling that risk. So he's adjusting. Nobody knows what to look at in terms of the data. But I think that's why he's struggling and everybody's grappling with that information.
After this speech, is he setting up the market to pay more attention, though, to the labor market report that comes out?
I think the market always thought the labor market was more important. And in fact, if you just look at the COVID experience, as long as they were concerned about the labor market, they weren't hiking interest rates until they were absolutely sure, the labor market's probably okay. And wow, inflation is way, way, way too high. So this is a Fed that has been trained. This is the third Fed of the United States. And, the most public, strongest opposition to Fed independence was probably right in the 50s before their independence with Truman. Humphrey Hawkins, after a very brief recession in 1969, in the 70s, they wrote this, dual mandate, which actually has more parts to it. It's a very employment-heavy mandate. So I think that the markets already realized the Fed would lean on that because the Fed's independence can be shaken by Congress and the board itself can be attacked as well.
You said earlier the Fed is not independent. Do you mean because their mandate is back to someplace and that's Congress, that's the lawmakers?
Not only is it made by the lawmakers, they set the targets, but this is a president that can legislate effectively. I mean, we saw this with the budget, where he pushed something through that touched entitlements in fast, lightning speed, and bent the budget rules, right? And maybe, I'm not saying whether this is right or wrong, I'm just trying to adjust to reality here. What's possible in this environment? These people that are voting on the rates are under tremendous pressure. They can come under attack from the Justice Department. But at its very fundamental, basis, the Fed's mandate is set by Congress, Federal Reserve Act, Humphrey Hawkins. It can be changed at any time. So I thought he was very artful. It wasn't like 2018 or a little bit earlier in this cycle where he fought on the interest rates, laid out the situation, said things are falling out on the side of ease here. And that's the best way to maintain the ability to act independently, is to not fight it, go with the data, do the right thing in the eyes of the current zeitgeist.
Well, Robert, let's talk about what the White House ultimately wants. And it's not just about lower interest rates of the Federal Reserve. It's lower borrowing costs and lower mortgage rates. Robert, if they drop rates of the FOMC, are they going to get lower borrowing costs and lower mortgage rates?
Well, they have a lot of tools. I left out actually the shadow chairman of the Fed running the Treasury. They're pulling in the issuance towards bills. They're buying back bonds, right? So they can, and they've signaled they're not interested in issuing more long-term securities. They're interested in issuing more T-bills. So if they can get a lower short-term interest rate, rightly or wrongly, and issue more bills, you're not going to have a runaway cost of issuance, over the next 3.5 years.
Are you, as an investor, less concerned then about what happens at the longer end of the curve?
I think that if they, in fact, run policy that's reasonable, which I think they will. As you pointed out, there's a wide range of people that are going to be appointed, have to be confirmed for appointment, and all of that. You're going to get a reasonable outcome in the back end of the curve. I don't think you're going to get a drop in long-term rates, but you know what? You haven't gotten a drop in long-term rates. We got to 4.25 basically 3 years ago, and we're still at 4.25. We've been plus, minus. You're going to get a lot of variability in the data, but you will get lower short-term rates. This is very positive for markets. In terms of corporations, they can deal with a little bit higher inflation. And with the tariffs, we're going to get a little bit higher inflation. But the Fed and the market overall is not going to demand higher real rates across the curve because the private sector economy can't pay it. And that's what you're seeing. I think that's why you had excess reserves piling up, is because nobody wants that money at that rate. And that will kind of cap private sector yields. Treasury yields will push up against that a bit, but overall, that's an environment where higher yielding fixed income product continues to outperform.
We've seen a lot of demand for that.
So I don't think the yield curve's going to get away from us. Yeah.
Robert Tipp, appreciate your time, sir. As always, Robert Tipp there of PGIM, fixed income. Bond yields this morning higher by just 2 basis points on 10s. 10s around 430, 30s around 490. At the very long end of the curve, yields higher by 3 basis points. What did he call the Treasury Secretary, Scott Bessent, there, the shadow Fed chair?
Shadow Fed chair, yeah. Which is something actually that came from the Treasury Secretary. I think it was on this program before the election. He was talking about this as an idea you can have. And what did he say? He says it actually doesn't want that anymore. He doesn't think it's a good idea.
He's backed away from that. Neil Dunter of Renmax saying that he's already on the Federal Reserve and his name is Governor Waller. And based on a speech on Friday from the chairman of the Federal Reserve, it sounded a lot like, to your point, sounded a lot like Governor Waller. Up next on the programme, we'll catch up with Liz Thomas of SoFi, Matt Bryson of Wedbush, Veronica Clark of Citi, Collin Martin of Charles Schwab. The third hour of Bloomberg Surveillance, just around the corner.
The Fed just has a lot less influence on the direction of things than they've had in the past.
We want the Fed to react before we see a big problem.
It does feel as if the balance of risk is pretty balanced at this point.
It's clearly long-term rates that drive the bus here.
Even if they cut in September, it's then not going to necessarily be a slam dunk that there'll be a December cut.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Easing into the trading week, we're negative by 0.24% on the S&P 500, down by about 1/3% on the NASDAQ 100. In the bond market, 2-year, 10-year, 30-year, unwinding some of Friday's moves. Yields up across the curve here by 2 to 3 basis points. The 30-year back to about 490.91. As we look ahead to the week ahead, things are shaping up as follows. PCE on Friday, Nvidia results on Wednesday. The main event for this equity market worldwide
Absolutely. Semiconductors going to be in focus, Jonathan. I mean, a lot of people, you've seen Wall Street analyst after Wall Street analyst continue to increase their price target on this name. 40% of their revenue coming from the likes of Microsoft and Meta and Apple and Amazon, which what did they do this earnings season? They boosted their capital expenditures. There's a lot of money going into AI, but what do we continuously hear? The likes of Frank Lee, it's all going to be about China and the rhetoric around China and what Jensen Huang says in terms of them shoring up their business in Beijing.
That comes on Wednesday. Big conversation about them and that exposure to China. Big conversation later in the week about inflation. The very fact of the matter is we're getting closer and closer to 3% all over again, and we might stay there for a while. And the Federal Reserve Chair has set us up to ignore some of this, focus on employment and cut interest rates.
They say that you have this dual mandate, and there's risks to both sides of this dual mandate, which is why you're in this curious conundrum when it comes to the Federal Reserve. But they have not been able to bring inflation to target for months. They have failed on that mandate yet. They get one whiff in the labor market that there's potentially concern to the downside, and already we see the bias from this Fed chair to open the door for September, which is why some people I'm talking to are saying a little bit of this could be political cover.
Keep going back to the calendar. September 5th for payrolls, a week later inflation, a week after that the 17th, the main event, the Federal Reserve, that meeting and a ton of forecasts. In financial markets at the moment, equities a bit softer, bond yields a bit higher. Coming up this hour, we'll catch up with Liz Thomas of SoFi with stocks close to all-time highs. Matt Bryson of Wedbush as Nvidia earnings take center stage, and Veronica Clark of Citi as investors prepare for a September rate cut. We begin this hour with stocks close to record highs. Liz Thomas of SoFi writing, it would take a lot to not get a cut in September. The Fed is more focused on labor in the near term, but over the next few meetings, I suspect the focus will shift to inflation. Liz joins us now for more. Liz, welcome. Let's build on some of that. The shift back to inflation, what's going to bring that about?
Well, when you think about where we are right now, first of all, the message that we received from the Fed on Friday was that the labor market had cooled. There's this average of 35,000 jobs added per month over the prior 3 months, which is a number that at least concerns them, and they want to make sure that they don't lose track of that. But I think what will happen as time goes on is us knowing and the realization in markets that there's no room to hike rates. There's a little bit of room for the labor market to cool before the Fed and before really the economy is going to look like it's in a lot of pain. We've got an unemployment rate still at 4.2%, and the expectation as of now is that it'll stay at 4.2%. So there's a little bit of room there for the labor market still to cool off. There's definitely not room to go back and have to hike rates if we lose control of inflation. But the other message that I think was very clear from the Fed on Friday was that, yes, we expect some effect from tariffs on inflation, but we're not going to see it immediately. And we're not sure if it's going to be just a one-time thing or if it's going to take a little bit longer. So that's why I say over the next few meetings, I think that the focus will shift back to inflation as some of that data comes through, and if they can get confirmation that tariffs were just a one-time shock.
Liz, do you still see it, though, in the same way the market saw it on Friday, that the chairman's current reaction function, the policy bias, is a pro-risk one?
Well, on Friday, what happened, I think that surprised markets was that he pretty much confirmed as long as things continue in this fashion, we're getting a cut in September. He didn't say that explicitly, but that was the interpretation. The other thing that happened on Friday that I think is a little bit lost in the huge rally is that before that speech occurred, markets had gotten down to less than 70% chance of a cut. So a lot of that was just repricing back up to, I believe it hit a high on Friday of maybe 90, 91%, 93% chance of a cut. So the repricing from 65-ish% back up to the low 90% was a lot of that rally. So just sort of a rejiggering of our expectations again. Is this a sentiment shift to back to risk on? It was risk on already. I think where we're at now is we're back to having priced in this first cut and really wondering, does that mean that there's another one to come? Is this the beginning of a cutting cycle? And how aggressive will this cutting cycle be? I still think that the jobs data next Friday is going to decide for sure whether or not we're getting that first cut. If it comes in at expectations, even slightly weak, that cut will be all but baked in. We're actually below 90% chance right now, but that cut would get all but baked in, maybe even another sniff of 50 basis points, which I don't think is likely. But in the near term, yes, this is positive for risk assets. At some point, if this is the beginning of a cutting cycle and if it starts to be in response to weak data, the market will have to digest the fact that, okay, the economy is now cooling quite a bit. We were cutting because we could. Now we're cutting because we're trying to prevent further weakness.
If this is the start of a cutting cycle, though, how could it be when the chairman himself said that tariff effects will be accumulating over coming months with high uncertainty about timing and amounts?
Well, that's what I think the market's going to have to figure out. Right now, we're acting as if it is the beginning of a cutting cycle, and this is going to be a slow message to keep going down further and further as the year goes on. We're pricing in a little bit more than 2 cuts right now before the end of the year. If you look at the time period when it might take tariffs to actually work their way into the data, and when I say the data, we've already seen some effect of tariffs in PPI data. We're looking for it in consumer price data, so CPI and PCE, and it'll take a little bit longer to get there because if the companies are not passing it through on the PPI side, on the wholesale side, it's going to take a little while to see that in the consumer side to the end result. So usually, let's say it takes 4 to 6 months for that to actually work its way all the way through the system. The Fed knows that. So they're buying themselves some time to say, okay, let's watch and see what happens over the next few months of inflation reports on the consumer side before we signal anything, promise anything to markets that this is going to be a slow cutting cycle that will continue.
Liz, what are you looking for in terms of the data we have yet to see when it comes to the August payrolls and CPI report that could maybe make Jay Powell walk back this idea of a cut in September?
Well, one of the things that I had been saying even before Jackson Hole was we're getting really excited about a cut in September when we've got a lot of data still to come. So we know that the CPI and the PPI data was a little conflicting. CPI came in okay, if not slightly weak. PPI came in really hot. So there is already some conflicting message coming from the data. We've got another CPI report. We've got the jobs report, obviously, which everybody will be watching with bated breath. We've got a PCE report. So there's still a lot to come. If some of those come in hot, especially hot, then I think we're going to see a lot more uncertainty before that meeting. But I do believe that it would have to be a series of hot data. So it wouldn't just be a one-time pop in CPI, a one-time pop in PCE, because they've already messaged to us that that might happen anyway. So I think unless this jobs report comes in really, really hot, I think we're getting that cut.
The jobs report is what I want to talk about, Liz. The prospect of an activity rebound. Can we just get into that a little bit more? I've seen that from Bank of America on Friday. Heard Mizuho talk about it too. Jordan Rochester said it's hard to get too dovish if US growth momentum from PMIs is real. Liz, how do you think about the prospect of a growth rebound as we work our way through September into year end?
Well, I think that's part of what the market is counting on with this broadening out trade that it's started to do over the last couple of weeks. You're seeing some strength out of smaller cap names. You're seeing strength out of other sectors besides communications and tech, and even outside of industrials, which has been one of the top sectors this year. So the broadening out trade is enthusiasm that we will have some sort of growth rebound, activity rebound that's durable and can reach into other parts of the economy. I think it's possible, but it's too early to say, okay, this is a growth rebound that's going to look like early parts of a cycle. Because if we're just embarking on a cutting cycle again during this period, we have to really wait for confirmation of some of that activity. And the reality is that the data had been moving in the opposite direction coming into this. Hadn't been moving in a terrible direction, but things were cooling off. GDP was cooling off a little bit. The labor market has really been stagnant in a solid place.
True.
Stagnant in a place of strength, but stagnant for a long time. So it would take some really exciting news or some shift in economic developments to, I think, broaden out the growth in a durable way right now.
Liz, it's good to hear from you. Always is. Thanks for sharing your thoughts. Liz Thomas there of SoFi. I think we all hope that we do get an activity rebound just for the good of this economy and the good of the country. The problem is we've had this low churn dynamic grip this labour market now for quite a while, and there's been this worry that it would start to break one way or the other, and a risk that it's broken in the wrong way.
And does that change how individuals maybe on the Fed that were feeling a little bit more dovish are going to feel going into that September meeting? Also, Jonathan, what happened to the fact that the president threw cold water on the BLS, their collection, the statisticians? What if we get a very good non-farm payrolls number? Is the president going to look at that and say, look, we're getting job growth back in America? Or is he going to say, no, actually don't touch the number, trust the numbers? That's what I said last month.
We'll look for confirmation from ADP. ADP taking on some additional importance over the next few weeks. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. We can kick things off with the ECB President Christine Lagarde warning against political interference in central banking. She said if monetary policy independence is undermined, quote, it becomes dysfunctional and starts doing things that it shouldn't do. Elsewhere, Keurig Dr Pepper has agreed to buy Dutch coffee and tea company JDE Peet for $18 billion. Once the deal is completed, Keurig plans to split the coffee business from other beverage operations. The announcement coming only a few years after the two combined. And finally, after 163 events and 0 wins, British golfer Tommy Fleetwood got his first PGA Tour victory at the FedEx Cup. He tapped in a putt for par on the 18th hole to win the championship at 18 under. Fleetwood taking home a $10 million prize. Once again, congratulations to Tommy. Up next, the morning calls plus Matt Bryson of Wedbush lifting his Nvidia price target going into earnings on Wednesday. Live from New York City this morning. Good morning.
I think going into the print, the fundamentals, the long-term story is still very solid. This week's earnings, a lot's going to be on whether they can actually surprise the market, especially the China piece. I think that has, there's a lot of uncertainty in China. The China government now is actually reassessing whether or not they're putting pressure on the Chinese customers to perhaps hold off on buying the NVIDIA chips.
That was Frank Lee of HSBC looking ahead to numbers from Nvidia. Those numbers drop in later on this week on Wednesday. If you're just tuning in, welcome to the program. Equity futures negative by 1/3% on the S&P 500, down by 0.4 on the Nasdaq. That's the price action. Let's get you some morning calls. First up, Bank of America calling American Eagle to underperform, saying navigating tariffs will be tough for the company. That stock is down by 4%. Your second call from Morgan Stanley lowering its price target on BJ's to 115, expecting tariffs and consumer sentiment to weigh down second half gross margins. And finally, Stifel raising its price target on Nvidia to 212, believing its leadership in AI infrastructure remains unchallenged. Those numbers 2 days away. Let's stick with Nvidia. Investors hoping the chip giant can soothe fears about AI spending. Stock little change this morning. Wild ride over the past few weeks. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, good morning.
Morning.
Wild ride over the past few weeks on what's been developing over in China. So what do you expect to hear in 2 days' time?
Well, so the buy-side bogey for the next quarter is obviously higher. They have de-risked the China revenue. But for me, the key commentary is around the reasoning models and how it's driving up the compute demand. We know that reasoning models use more compute, so that's a driver. Everyone called out how they were short of GPUs in the past 90 days. But look, when it comes to the long-term sustainability of growth, it comes down to what the sovereigns are doing, what China exposure is, because half of NVIDIA's revenue is from hyperscalers. The other half, the growth sustainability, hinges on sovereigns and China. So we know China is not ready to buy H20s anymore. What happens to the sovereigns given the geopolitical situation we are in right now?
How do they manage the China situation? Just breathe some life into that conversation. Clearly, the Chinese are offended by the fact the Commerce Secretary, Howard Lutnick, based on reports, turned around to them and said, you're not going to get our highest tech. So they said, OK, we're not buying the H20 either. How's this going to resolve itself?
Well, so look, I mean, H20s was a SKU that they were trying to sell. It was lower ASPs. To my mind, Street is focused on NVIDIA's margins as well. So if the margins continue to go down, they said in the second half, margins will go back to mid 70%. That is where, there will be increased concern about EPS growth and just the sustainability of EPS growth, because margins is what has drove the, investors to underwrite a 40 times earnings multiple. So from that perspective, China is very important because that's the incremental demand. And if they're not even able to sell H20s, it just tells you they will face more ASP pressure because you take out, the biggest large language model companies that are training their large language models on chips that are not NVIDIA's.
Mandeep, stay with us. I want to bring in Matt Bryson of Wedbush. Raised his price target on NVIDIA to 210 going into earnings on Wednesday. Matt Bryson joins us now for more. Matt, welcome to the programme, sir. Let's talk about what you're expecting on Wednesday and the margin risk that Mandeep was just talking about.
Yeah, so on Wednesday, I think that NVIDIA gives us certainly better numbers than they guided to. We've only gotten good news during the quarter in terms of both how they've executed, but then CSP spend, also how Blackwell Ultra's ramping. And so typically management has given themselves a little bit of wiggle room, and so would expect another beat. In terms of margins going forward, or margins during the quarter, again, with execution looking better, I don't see a whole lot of risk to margins in the quarter. I think the question going forward was if NVIDIA has to pay this export tax, what might the impact be on gross margins to product going to China? If that China revenue's lower, if anything, in my mind, that moderates the risk around gross margins.
Matt, when you say export tax, you're talking about the 15% of the profit they would get from selling these chips into China only. But if Beijing's not buying the chips, they're not paying that tax. How much is your price target and your lifting of the price target relying on them still being able to sell into China?
Yeah, so if you look at my model, I added roughly $1 billion and a half to revenue in their fiscal Q3, fiscal Q4. Versus, remember, in fiscal Q2, they were doing $8 billion to China. So I have a relatively modest increase in revenue. I still expect that they are able to ship some H20s into China. Far more conservative, though, in terms of what I'm expecting versus what they had been shipping previously.
How concerned are you about the fact that there's reports that NVIDIA is telling its component suppliers to stop making production for the components that are going into the H20s because they're not going to have the buyer, Beijing, when it comes to these chips?
Yeah, remember, NVIDIA had a relatively abrupt notice back in April when they had to stop shipping. They wrote off a bunch of inventory. Some of that was work in process, some of that was finished inventory. I believe that one of the things that NVIDIA has been trying to figure out, and the variables have obviously been changing, is how much additional inventory do they really need to produce, or how many additional chips and boards do they need to produce before they start shifting to newer models. So there's been a lot of news out recently around them having Blackwell variants of those China chips. So I think in part what NVIDIA is adjusting is how much additional production, how much additional inventory do they build, given they already have this inventory in-house, and they've got a new model that's coming out in, let's call it, the next 6 to 9 months.
Matt, let's turn to Intel, another company that falls under your coverage. Last time I looked, you had a neutral rating on the stock. Have things changed for you since Friday?
No, not really. The U.S. government told us that instead of them giving Intel grants to build out factories, they're going to give them grants to get a portion of Intel. So Intel has, ostensibly the same access to capital that they had previously. The difference in my mind being that shareholders are diluted, and now you have a U.S. government that's saying it will be a passive investor unless it's not a passive investor, as far as I could read the language.
Well, Matt, can I get into that? What's passive about this White House? How active do you think they're going to be?
I don't know. That's a great question. So does this lead us down a path where the government takes steps to advantage Intel versus other competitors, in part because of the stake? That I don't know. Do they allow Intel to potentially spin out the foundry business, or fab business, which would be a way for Intel to create value for shareholders? There was language around them having an option granted if Intel owned less than, I think it was 50% of the fab business at some point. So maybe that means that a breakup could be on the table. But the answer really is I've been surprised again and again over the last 6 months, and I expect to be surprised over the next 6 months.
Matt, do you think, given this stake, that Intel is going to operate what's best for the company and shareholders, or it's going to do the bidding of politicians in Washington?
I think to some extent the two are somewhat the same in the sense that I think what shareholders need is they need Intel to have a better product and to regain share, to regain margins, to regain profitability. I think for Washington, they want Intel to have a successful fab. And in that sense, their goals are aligned, right? The U.S. wants a stable, solid producer of semiconductors, and particularly advanced semiconductors. That's what Intel needs to be to create profits for shareholders.
For America's national security is what we need. Matt Bryson of Wedbush, thank you, sir. Appreciate your time. Mandeep, I want to come back to you. It's a gut punch for capitalism, according to a lot of people. Is it a good thing for Intel?
I mean, I equate it to the situation where they were too big to fail banks back in 2008. The government bailed them out. And even in the last 2 years, the affiliation that Tesla had with President Trump was a positive for the stocks. So from that perspective, I do think, near term, it does sound like a positive given the government wants to save the company. They want to save the foundry business. And I wouldn't be surprised if Intel ends up winning some orders from fabless chip makers for some sort of
Wouldn't
design.
surprise me either. Would not surprise me either. Whether they can actually build the stuff that those fabless companies actually want built is another thing altogether. Do you think they can?
It won't be cutting edge, but Intel is still the leader when it comes to CPU chips. So granted, they won't be building the cutting edge GPUs, the 2 nanometer GPUs that TSMC is building, but still there's a lot of semiconductor business because of this data center and AI wave that is out there. And I think even if Intel wins a small sliver of that, that'll be positive.
This is going to be quite a ride for the next few years.
I like how Mandeep says he wouldn't be surprised. I don't think anyone would be surprised what the next step of this story is. And Mandeep's talking about if Intel's able to win some business. Is it going to actually be winning business because of their technology, or are they going to be dictated? Other companies will be dictated that they need to buy their product.
I keep asking the same question. Their revenue in China, what's it running at? 30% of their revenues coming from China for Intel? Waiting for the Chinese response to this. The US government taking a stake in a supplier of technology to Chinese companies.
I think the U.S., though, will just laugh in Beijing's face because this is exactly what they do.
I'm sure they will. But if the shoe was on the other foot, you know exactly what would be happening.
Absolutely.
And this is what we've got to watch to see how this plays out in Washington, D.C. and beyond in Beijing. Up next on the programme, Veronica Clark of Citi, as we await key inflation data later this week, plus your morning movers, Wayfair shares falling on reports of possible tariffs on furniture. Friday snapped a 5-day slide on the S&P 500 with the biggest daily gain going back to May. Equity futures this morning, and good morning to you. Negative by a third of 1% on the S&P, down just 0.4 on the Nasdaq 100 as we count you down to earnings from Nvidia, just 2 days away. 1 hour away from the opening bell. Let's get you some morning moves and cross over to Danny Berger for more. Hey, Danny.
Hey, John, the big deal to keep track of today, and that is Keurig Dr. Pepper announcing that it would be buying JDE Peet's, rather the coffee chain listed in Amsterdam. That deal, once completed, it would also see Keurig and Dr. Pepper split into its coffee company and its other beverage company. After 7 years, when these two first merged, the acquirer often falls in these types of deals. So Keurig Dr. Pepper down about 7%, with JDE surging in the Amsterdam trade. Intel, that's also higher. You all were discussing this before the commercial break. The U.S. government taking just under a 10% stake in the company, funding the $8.9 billion through the CHIPS Act. Intel saying that it would be a passive stake by the U.S. government. Even so, those shares up 1.7% this morning. Finally, also after the bell on Friday, Trump announced that the U.S. would be investigating imports of furniture coming into the U.S. for 50 days, and after that 50 days, they would look at a tariff rate. So pushing forward to sectoral tariffs. So companies like Wayfair, Williams-Sonoma, some of those other furniture makers falling in today's pre-market trade. Those shares, John, down 7.5%.
Danny, thank you. So is this a stimulus bill for furniture sales over the next few months? We're going to front load that too.
Potentially, yeah. I mean, if you think that there are going to be higher tariffs on furniture and you're thinking about redoing your home, or if you're one of these companies, you're going to want to start stockpiling.
It is never ending. I keep going back to the Walmart numbers from last week, when the CEO came out and said tariff costs are rising every single week. They're going to keep on rising.
Absolutely. And what did we hear from Henrietta Treyz? If you see IEPA being struck down, this means by a sector basis, the administration is going to have to do 232 or 301 investigations. That means every sector is going to get one of these investigations.
Inflation in focus this week. Core PCE. The key data point to watch, the Fed's preferred measure of inflation due out on Friday. Ira Jersey of Bloomberg Intelligence joins us now for more. Ira, welcome to the programme, buddy. What are you looking for later this week? Are we seriously going to have a 3% inflation print in America and a Federal Reserve come out, cut rates and signal there's more to come?
Well, I think if we get a 3%, which is not the consensus forecast, then the Federal Reserve would have to rethink a September rate cut. But if we get the year-on-year number around 2.5%, so maybe slightly below what the consensus is, then I think that does open the door for the Federal Reserve to cut. And the Fed doesn't like to be one and done or just cut a little bit and then pause and wait. There tends to be some policy momentum. So I think the Federal Reserve needs to be convinced that they need to start, and then once they start, they'll cut interest rates 100 or 250 basis points. And so you need a weaker than expected number probably to ensure that the Fed is going to cut in September.
Ira, just want to lean on the language from Chairman Powell directly in his speech, and I'll read it verbatim. The effects of tariffs on consumer prices are now clearly visible. He goes on to say, a reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. That last line, Ira, I think is so important. Isn't that a chairman basically setting us up to ignore inflation for several months and maybe even longer into 2026?
Well, that's certainly the way that the market took that kind of language on Friday, and also the lack of shift toward an inflation bias in the policy framework, which I think was very important. There were a lot of people who thought, oh, the Fed is going to lean more toward worrying about inflation instead of employment. And when they didn't do that, that's one of the reasons you saw that pretty significant rally, particularly in the front end of the yield curve on Friday. I don't think that the market's going to look through it, but I think that the market is not going to be as worried about the goods inflation, but look at and focus on the services sector, and not only the housing sector, but the core services sector that is very domestically focused. And are these goods price increases really affecting consumer behavior and maybe slowing price growth in services and maybe slowing consumer spending? Because remember, we get that PCE data, we also get the personal income and spending data. So that will be, at least in my estimation, as important as the inflation-only data.
Ira, just before you go, I just want to talk about developments in the yield curve. Clearly the curve steepened on Friday, but the whole curve dropped lower. Had a bit of steepness come back through the curve this morning, but yields are pushing higher. That 30-year move, yields up about 3 or 4 basis points this morning. Ira, just how disconnected and unanchored is the long end from this story, this conversation we're having about the front end?
Well, it's not completely, and we've been thinking that the long end was going to stay basically in the range where it's been recently, and the front end was going to do all the work in the curve, where we get this bull steepening of the yield curve, where the front end rallies, the long end does a whole lot of nothing, because people are worried about the fiscal situation and the potential for higher long-run inflation if the Federal Reserve, in fact, does cut interest rates very aggressively.
Ira Jersey of Bloomberg Intelligence. Ira, thank you. 30-year bond yields higher by, let's call it 3 basis points, 491 right now. Let's stick with inflation and the path forward for the Federal Reserve. Veronica Clark of Citi writing, the worst-case scenario for tariff-related inflation has been avoided. The biggest test of tariff pass-through dynamics will likely be data from August through October. Veronica joins us now for more. Veronica, good morning.
Good morning.
You noticed the same line on inflation. Is transitory back at the Federal Reserve?
That word specifically, probably not. But yeah, this is a Fed that's setting up to look through maybe multiple months of some stronger inflation data. Obviously, it's going to depend on the details. Do we see services inflation slowing? Are inflation expectations anchored? But yeah, that was a pretty dovish comment from Chair Powell.
If they're saying look through it, then basically the market is only going to be focused on what? The labor market?
I think that's the most important. And there definitely, can be some stronger inflation scenarios. We don't know exactly how this will all play out. But I do think it's probably the case that demand is soft enough, so you're not really getting these big price increases all at once. This could be somewhat drawn out, and that comes down to the demand backdrop, which is the labor market. If the labor market is slowing, that's what they're going to be much more focused on.
Based off all of this and Powell's speech on Friday, is the Fed basically accepting that they'll never hit a 2% inflation target again?
Or
at least in the foreseeable future?
Yeah, I don't think so. I mean, I think at some point, if we really are sticky at something like 3%, that they won't be comfortable with that. But we will have, this multiple month period of some stronger data, but it won't necessarily be the true persistent kind of inflation that would get them concerned. And then maybe a year or so from now, we're back towards 2%.
I find the analysis of the labour market slightly more controversial. This was an individual that sat at the news conference a number of weeks ago. Predates NFP, sure. But think about what he said at the news conference. Labour market solid, anchored the view around the unemployment rate. A few days later, what did unemployment do? Not a lot compared to the massive negative revisions we saw in payrolls. Now, I'll spell out basically what he told us on Friday, and you can give me your analysis of things. Essentially, the chairman is saying that, yes, we've had a step down in supply and a step down in demand, which has kept the unemployment rate pretty stable, given everything that's been going on. But I'm going to put more weight on the step down in demand. Now, that's your camp. I understand that. But surely for the Federal Reserve, shouldn't they be focused on measures of slack? Shouldn't they be able to sit there and say, yes, demand's seen a step down, but measures of slack have remained stable, so we can remain on guard for inflation? Yeah, I think if we don't see the unemployment rate moving higher, it will be hard maybe to get certainly bigger, cuts all at once. We're not expecting 50s. But I think the issue, and Powell did still talk about, the labor market this way in July, is why is demand weakening? What's going to stop that? If rates are restrictive, rates are probably not where they should be then. That's a fair comment. Just how restrictive are we then?
I think rates are restrictive. Obviously we look at the long run dot, like markets, we're pricing, that five more cuts or so. But I think if you look at something like housing, that's a really good example of you don't even necessarily need rates to go higher. You just leave them at restrictive levels and you've gotten that contraction again.
John's been bringing up the point, though, when the Fed cut last year, it actually didn't help the housing market because mortgage rates actually went up. Yeah. How concerned are you that this is going to happen this time around?
Yeah, I don't think we're really concerned that 10-year yields are going to go too much higher if the Fed is really cutting. We saw that on Friday. A dovish chair means 10-year rates lower too.
You also said we don't expect 50s. Meaning, do you expect a cycle of cuts?
Yeah, we do. I think it is harder to get those big cuts at this stage, at least starting with that. Obviously rates were at a higher level last year. You weren't as concerned on the inflation side of things. But I think this is a Fed that's going to proceed with a series of cuts.
What are you expecting for 2026? And is there a dividing line between what happens before May and what happens after May?
Yeah, we are still expecting that this is going to be a Fed that is data dependent. Obviously, they have to majority vote to have a policy reached. We still think it's a consecutive 5.
A consecutive 5. So you don't think a whole lot changes when we get that new Fed chair?
I don't think necessarily. Yeah, well,
where
obviously.
Where does that thinking come from?
I mean, there is obviously a lot of pressure on them, but I think it depends obviously on who the chair will be. If it is someone like Governor Waller, market's very familiar with him. We know exactly how he thinks.
Governor Waller would be a super comfortable choice for Wall Street, I think, at this point.
Absolutely. He's someone that Wall Street really admires and backs at this moment. Even if they don't agree with his view, they think he's credible and they think he can represent an independent Fed and not someone that's just doing White House bidding like maybe the president's own NEC director.
Can we just finish on the balance sheet? What do you think the approach of the new Fed chair will be to the balance sheet?
Yeah, it's really not gotten a lot of attention. It could be interesting if it's someone like Governor Waller. He's been a bit more hawkish on the balance sheet, allowing it to run off for longer. But I imagine for now it's just as is.
I've picked up on the same dynamic. I've been very surprised sat here that there hasn't been more attention on the balance sheet. If you listen to what the White House wants, it's not just lower rates, it's lower borrowing costs, it's lower mortgage rates. Which begs the question, if you're not going to get it through adjusting short-term rates, do you have to get it through other means?
Right. There's really not a lot of talk about that right now. But they are very focused on cuts, especially because they are issuing so much in the short end. So that really does depend on what the Fed rate itself is doing. Obviously, for consumers, 10-year mortgage rates, all of that matters more. But for now, if it's federal borrowing costs, that depends on what the Fed's doing in
Veronica
terms of
Clark,
rates.
Citi, appreciate it.
Thanks.
That duration is getting shorter and shorter and shorter, and you imagine it might get a whole lot shorter.
Absolutely. And also, though, to Veronica's point, just thinking about the politics of all this going into the fall. If Citi is expecting some hotter prints to come in because tariff rates, we're going to see that pass through now, potentially with companies. At the same time, the Fed potentially, they think, is going to be on a cycle of cutting. How political is that thing that they're only looking at the employment even though we're getting hotter CPI prints. That's going to be challenging.
Bond yields this morning higher by 3 basis points across the curve, up 3 on 2s to about 373. On 30s on my screen on the Bloomberg at the moment, up 3 also and back through 490. That's the price action. Let's get you an update on stories worldwide. Here is your Bloomberg brief. President Donald Trump taking game at NBC and ABC, saying they are, quote, the worst and most biased networks in history, adding that he would support the FCC in revoking their licenses. Elsewhere, the American Civil Liberties Union saying the Florida detention center, known as Alligator Alcatraz is being run illegally by state workers who are holding immigrants off the grid. The ACLU is suing a group of agencies involved in operating the facility. And finally, K-pop Demon Hunters topped the North American box office. According to Variety, the film is projected to gross $18 to $20 million over the weekend. It's a rare win at theatres for Netflix after it released the musical as a one-weekend-only sing-along event.
You're looking at me because you think I'm going.
No, I just have no interest in this whatsoever.
K-pop is cool. It might come up today at the White House, given you have the South Korean president visiting
singing at the
President
movies that I'm just not into at all. Like people, no. Like the sing-along stuff. What was that with the ABBA movie? What was that, Mamma Mia? And people started singing along to that stuff. No interest at all. All right, up next, setting you up for the day ahead. Plus, we'll catch up with Collin Martin of Schwab as investors price in a September rate cut. From New York, this is Bloomberg.
There's an enormous amount of pressure on the Fed right now that cannot be ignored. We haven't seen pressure like this since Johnson and Nixon. It's very significant, and it's more direct. It's more public. It puts the Fed in play in a lot of ways, both on the market and the public's eyes. So yeah, I'm very worried about it.
That was the former Kansas City Fed President Thomas Hoenig there on central bank independence. I have to say I prefer it public and direct than private and behind closed doors.
Yeah, well, this was the idea around President Nixon, Arthur Burns. They would have these meetings together, but no one knew how overt really Nixon was and direct he was to Arthur Burns and what he wanted to see. This is very transparent. We can all read and see what the president is saying about the Federal Reserve every single day.
We know exactly what we're getting. Bond yields are higher this morning by 2 or 3 basis points across the curve. Equities are lower by 0.3% on the S&P 500, down by about a third also on the Nasdaq 100. As we count you down to the opening bell, here's the trading diary. Today, Fed speak from New York President John Williams. Look out for that. The New York Fed president later on this evening. That's one to watch. As we look ahead to tomorrow, durable goods orders. Wednesday, the big one for earnings, results from Nvidia. Thursday, another round of jobless claims plus a read on GDP. And on Friday, core PCE and UMich consumer sentiment, for whatever that's worth at the moment, which feels like a political poll, a survey.
Right. Remember what Governor Waller said? He said, oh, yeah, that thing. That's sentiment.
It's how it's been treated. That thing. Let's stick with that thing. Inflation, the stock rally, retreating this morning as investors eye a September rate decision. Collin Martin of Schwab writing a soft labour market is in the driver's seat when it comes to monetary policy expectations, but inflation concerns haven't dissipated. Collin joins us now for more. Collin, good morning.
Good morning.
Good to see you. What changed for you after Friday?
Not too much. We were already pricing in a September rate cut. I mean, there's all these headlines and the markets go haywire about everything he says and doesn't say. If we go back to June, a majority of the FOMC participants were already expecting this. If we go back a few weeks ago, we were expecting a rate cut and probably a second one in December. It seems more likely now. I'd say Powell stopped short of confirmation, like what we got in 2024. In fact, when he said, this is happening. But the door's clearly open. He mentioned that, we know that he thinks monetary policy is restrictive. It seems like the door's open to kind of ease it a little bit. But in the grand scheme of things, I don't think much has changed because I think the Fed will continue to be data dependent going forward.
There appears to be a reaction shift, though, and that's important with regards to the debate data dependence. There seems to be a decreased sensitivity to inflation and maybe an increased sensitivity to the labour market. Is it fair there's been a bias shift at the Federal Reserve?
I think so, but I think the data supports that. We at Schwab, we kind of had the same shift as well, leading up to those pretty negative revisions that we got a few weeks ago, almost a month ago now. We thought the labor market was pretty stable, with maybe some negative things, some cracks forming underneath the surface. That kind of pulled forward a lot more of those cracks, and maybe it wasn't as stable as we expected. So I think it's fair to focus more on the labor market than inflation. Yes, inflation is still above the Fed's target. It's been above the Fed's target for years. Yes, it's moving away from the target, at least over the past few months, but we're not sure it's going to necessarily reaccelerate from here. I think a lot of that, or some of that, does come from tariffs, but I won't use the T word, but it might be a one-time shift that the Fed might look through a little bit. I think they're still worried that we can see more price increases going forward, but unless we keep getting tariffs on tariffs on tariffs, that rate of change isn't going to be there in perpetuity.
But what makes you so worried about a 4.2% unemployment rate?
Not much. That's something that again, we have shifted our view a little bit. I was looking at that specifically as that sign of stability. I've kind of lost count now because we've shifted a little bit, but I think it's between 4% and 4.2% for 15, 16 months, something like that. It's remarkably stable. And even with those negative revisions, it was still kind of in the top end of that range. I think when you round it a little bit, it ticks a little bit higher. And it was more proof of the low higher environment.
So why are they cutting?
Because I think
they're thinking about
cutting, haven't done it just yet. I think there's just things that are more concerning that the trend can worsen from here. It looks like if that trend we got over the past few months with non-farm payrolls, maybe that 4.0 to 4.2% range for the unemployment rate, maybe we get 4.3, 4.4, 4.5 over time. And I think that's going to be a little bit concerning for Fed officials.
Unleashed a super speculative rally, not just in equities, but in bonds too. We talked a lot about investment-grade credit spreads, multi-decade tights, high-yield spreads, 279 after Friday. How much tighter can credit spreads go in this country?
Well, not much. I mean, they can go. I mean, I've been pretty cautious about it for a while, but spreads have stayed in this really tight range. And if we look at that, we'll say 279 for high yield, all-time low or cyclical low, we'll call it post-pandemic. We're looking at around 2.5%. So just kind of definitionally, maybe we see 20 or 30 basis points lower. I'm concerned, though. We've been cautious for a while.
What are you concerned about?
I'm concerned that I think we're seeing a lot of dynamics with supply and demand, people really reaching for yield, stock market optimism, a lot of demand in the private credit space. And I think when we get all this demand moving into an asset class, I think you lose price discovery, and it can't mask things that are going on underneath the surface forever. And we're seeing, defaults are still relatively high. They've been hovering, depending on Moody's or S&P, whichever data you want to use, in the 3, 4, 5% area for I think close to 2 years now. And that's well above levels we saw in 2021 when we saw spreads at these lows.
Do you find it odd that the chairman came out on Friday and said, I'm worried about demand? I'm not worried about inflation so much because actually I'm worried more about what's happening with demand. And then we saw spreads grind tighter.
I think, the Fed's view and then the market's just getting optimistic about the potential for rate cuts. We're worried about demand also. If we look at GDP, one of the things that we always focus on is personal consumption. And the first 2 quarters, I think on average, if you put them together, you're looking at around 1% or so annualized. And if we look at the past 3 years, it's closer to 2.5%. So I think that is something that probably is concerning for Fed officials. And we're concerned as well. And that's why we have that sort of defensive bias in terms of not taking too much risk with your portfolio. And the idea that we think yields of all maturities will probably fall a little bit further.
Well, let's get into that defensive posture. Where do you want to be across the yield curve? Where do you want to sit? Where's comfortable at the moment?
We're comfortable intermediate term. We like
you and everybody else.
Us and everybody else. But there's risks on both ends, I think. On the short end, reinvestment risk is clearly here. And if we look at where a money market fund yield is right now, or a T-bill, 4% plus, if market expectations are correct, and who knows what we'll see over the next 12 to 15 months, we can see those yields closer to 3% next year. So we'd rather lock in a little bit. On the long end, though, inflation's still high. We still have fiscal concerns, and the term premium is relatively elevated, and we're worried that it can stay elevated given all the trade uncertainty, fiscal policy uncertainty, and the need for higher yields to attract those investors.
Do you see 4% on 10s as almost the floor then? How are you thinking about things? Even though you're going to see this big drop off at the front end, Where's the 10-year sitting?
Maybe a little bit below 4, maybe in the 3.75% to 4% range. We kind of give those ranges. If we look at what's going to pull yields significantly lower, we'd probably need a recession for that. In a recessionary environment, maybe 3.5% or less. But if we just get a moderation, which is kind of what we've seen lately, we think maybe just below 4%, which means a steeper yield curve and probably still attractive yields in our.
Would you expect issuance to tighten up even more? Duration just to shorten from the Treasury, given what you just described?
I think so. We know what Treasury wants to do. We know the concerns that Treasury and the whole administration has about the borrowing costs here, and we know what they can impact. And if we do get a lowering of interest rates because of either the mandate that suggests it or more people on the committee that are demanding it maybe more vocally, we'll probably see lower short-term rates and we'll probably see the Treasury continue to take advantage of that.
Collin, it's good to see you. Thanks for dropping by. Collin Martin there of Schwab. That dance between Treasury and the Federal Reserve over the next year, the one to watch without a doubt.
Absolutely. And the president has made it pretty clear. He's like, if we're the ones paying net interest payments bigger than the defense budget, that those rates should be lower as the U.S. government is paying off those bonds.
First day back after vacation. Feel good?
Yeah, it's a little sad. It's last week of August.
I know. You've got to take it in. Take it slowly. I don't wish away summer. You know how a lot of people here wish away summer after Labor Day? It's sort of over. It's not over. You've got the whole of September.
Yeah, we should enjoy September.
Just
it's a good point.
Embrace September and the warm weather that's still to come. Bramo's doing just that. She's going to enjoy the final week of August. She'll be back with us next week. Conversation continues tomorrow. Peter Chair of Academy Securities will join us. We'll catch up with Marissa Adams of HSBC. We'll speak to Jim Bianco of Bianco Research and the wonderful, the brilliant Torsten Slok of Apollo. Stack line up tomorrow. Looking forward to catching up with you. For this morning, bond yields bouncing back by about 2 or 3 basis points across the curve. Equity futures just a little bit softer, negative by 0.3%. From New York City this morning, good morning to you all. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.